Good morning. September 18th. We're going to be streaming all day today. Stocks, options, futures trading. Sub up, like up, comment down. Happy money sticks around. Happy Money Monday too. Hope you had a good weekend. Just had the bell 2 minutes ago. We'll be watching SPY, GME. Looks like Cosmo Kramer's up. Express, Barbecue, AMC. Let's see what we got. Thank you guys for joining. Thanks for the support. Thank you for your early likes. And follow us on Twitter at HappyMoneyYT. And we have a Discord server as well. For those in the description. Here we go. Market opened up pretty much flat. A little bit green here. See, GME flat as well. Sold off into the open, down 2%. Barbecue still in its huge widespread, 16 cents to like 19 cents. AMC is down 2.8. I guess he tweeted about selling wine and chocolates, so that's kind of interesting. See if we can hold this trend line. Big week. We've got Powell this week on Wednesday. Mullen's up a bit there. Mullen's still looking good. That's crazy. Yeah, 7%. NFT limited. GME right back down to that range. BFS is flat. ACB is down 11.5. I'm about to get stopped here, I bet. Oh, I wonder if it gapped past my stop. No, it didn't. Might get stopped out on the remaining shares. Okay, it's a big volatile trade. Barbecue's now green, 18 cents. Yeah. We're gonna probably not watch this one that much anymore. Not much to really see, honestly. So SPY last week completed this inverse cup here. Since we didn't get a big gap down, might start to make this handle. Could retrace probably almost all the way back up here to 446. Before turning back around. ETOO is up 30%. EMU's down 3. Zim's up a lot. Zim. I might not make big moves until Powell. It'd be pretty tight ranges or copy even. Kind of right in the middle of everything. We'll build a conference today at 10. It shouldn't matter. Tomorrow we have housing starts and building permits pre-market, and then Wednesday is Fed interest rate decision, and their Powell at 2 and 2:30. Those are the big movers. Morning Passing Cloud. Morning Maui Sam. Morning Guts. Mitchell Joe. Oha. Market crash. Maybe before the end of the year. Got a catalyst this week that could potentially start it. Or at least a cover up for a catalyst. Not sure how much more pumping blow off top they can do before they dump it. 3.5 on GME. Barbecue 18 cents, up 2.8. Anybody able to buy it? Or is that still dead? AMC down 4%. AMC gets a bounce there. Got VFS. This is the way. Volume and some rip. 3.5. ACB down 840. I think it maybe just hit my stop. Just like the other one. Yeah. Oh no, it didn't. Oh, close one. Oh, the other one for 5. I could get back into 5. Let's see. Leave it alone. RSI is not too strong there. Nice one back down here. AMC's down 5. Low of the day on SPY. Jones up 5%. $9.45. Trying to be patient. I don't want to get some calls though if we retest the pre-market low. % on VFS. All right, low grinder. Holla. Dish is down 2. Nice trend on Dish though. This might be a nice little long play. Or maybe up to like 7.5, 8.5, maybe even a break. Five and a half there on AMC. Like a Head and Shoulders. And a break of that trend, which is not good for the longs. Yeah, I guess it was Friday, the day we had the sell-off? Yeah, that was a pretty big sell-off on Friday. So might get a little continuation of that. Dig a little deeper for that cup before we get a bounce on the handle. We can maybe pre-market. GME down 4.5. Egg is up 2.5. Got nickel up 18. Like Nicholas chart. Alright, gotta barely caught the bell this morning. But we made it. Thanks, guys, for your support. Happy Money Monday to you all. For your likes. Appreciate it. Board. Yes, below $1. Be a nice pickup on it with a pretty tight stop. ACB stopped me out. So not yet. VFS is now red. See about that, VFS. See about you. I should have closed those AMC calls. Like the level bounce I was expecting. Rumbles down 7. gonna get a couple calls there. One way for low of the day, but I do have a line somewhere. This kind of a support pre-market, so let's see. Got VWAP to contend with. Breakout up there. VWAP test. AMC does kind of move with SPY also, kind of interesting. There's a break on VWAP. I'm selling one here. Put a stop on the rest. Break even. Just doesn't work out. Smoke some weed. %, Nikola. Yeah, new high there, Nikola. It's Mullen, dude. Mullen's now red. Wow. BB might just be consolidating. Bouncer on GME with the SPY. Grab some puts there. I think I got stopped out of my calls also. Yeah, I just got stopped in my calls, the rest of them. Trade with smaller contract sizes this early in the morning. Well, like scalping, I'm not as good at it, so just smaller positions. They've got buying power for the bigger moves at themselves. In your hands, it's good. Yeah, market's just chopped around for now. Much to trade. Celsius and cone. Like an early morning energy drink. Cone? Like ice cream cone? Is that another type of weed paraphernalia that I'm not familiar with? Carvana? Green? Just don't know when to quit. I don't Carvana. Alright, I stopped out of those puts. Wait. I just put a break even on them because, yeah, I want tight stop. Early morning chop. Marijuana cigarette. We used to call those spliffs. Kodak. That roller coaster ride. Okay, grab some more calls there actually, back in them. Oh. Yeah, it does have that VWAP chop syndrome to get over. GME 7. See down 5. Looking at ACB. ACB had a bounce a little bit. So CGC down 12.5. HKD found a new range, $5.50. Okay. Mullen selling off now, down 6%. Climbing a little bit, still in this morning chop range. Build a little cup here. Back below view up now. Hardcore chop. AMC coming down some more here on 6.3. those calls. That was fun. Run is down 3 1/4. Buy chop. Wow. Look at that candle. All 442 puts. Okie dokie. we've completed that cup. Give you a little handle. We break out new highs. Down 7. FS now negative 3%. Close my puts. Wanted to close them further down, but didn't wait. Not sure if we're gonna get it. Still kind of in a chop. Got some calls though. Get a bigger pullback, I'll probably get some more calls. Disgusting early morning chop. Like when you wake up before the sunrise to go slalom skiing at Glassy Lake. Had this awful wind all night. Got white caps. Oh, really, Carvana? $5.5% on Carvana. Beyond is flat. I'd say it's down 0.7. Getting close to the high of the day here. Sell one of these balls. This could be the completed cup. Get a handle. or if we're just back in the chop. ACB bounced up there a bit. Back to the pre-market levels. 3.5. Rumble. Yeah, that was selling off. Yeah, I don't know why it's down 10. Close that support, 580. I don't see any news. No news. No new move. No news move. Strength, the Carvana strength. Mess with it. Dance around the high here. Morning, Macaron. Come here for the flesherinos. I'm gonna go scuba diving. Come for the flesherinos, stay for the profitable calls. Welcome to Spyland. Spylandia. Happy Money Monday to you all. Up on 1 hour market open. Thanks guys for your likes. Appreciate it. All 13 of you. Millionaires in the making. Barbecue doing? Rubber coating. BFS is down 2.6. ACB only down 2.9 now. Not bad. C still down 7. Me down 3.9. I still just chopping around. And I made a cup here. Could be a handle. I don't know. It's so choppy. Barely green on the day. Runs down 4%. You got a 1 day GME put? Oh, you got, what do you mean, like a 0 day? GM looks it's in a little uptrend. I don't know how you like to scalp anyways. Sounds pretty nice off this support. Kind of making higher lows here. A pretty clear trend range presently. I'm on strike with him. Get the wicks on SPY, dude. Ugh. GME down 4.25. Not a very small day on GameStop. Pretty big rejection. Also left a gap up there. Maybe climbing up. Still chop. No breakout yet. For a little more of a pullback to get some more calls. Might not be as fortunate. Another retest of the high. Oh, there you go. New high on the day. Sustain it. I don't know. Turned into a wick. Reversal candle, look at that. Look at that. Wow. 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 Just a little trigger, stop trigger maybe. Back to VWAP. Hate taking trades at VWAP. Okay, I flipped again. See if we get any kind of continuation. Or is this the handle? I don't know. Copy still. Pretty big red candle there though. Full VWAP. GME down 4.5. Don't like that VWAP. Public's getting his wish. Green yet on those puts? Got him like right here. Maybe not. The green to red candle's pretty ugly, so I think this probably wants to come down. Be setting up a inverse cup now. There you have your chop. E 4.3 down 7.4 741 AMC happening right now. Seems like when the SPY decides the direction it's going to be pretty violent with all this liquidity it's built. ACB only down 3 now. FS down 2. Eyes coming down here a little bit. Yeah, I mean, you just lost a theta through all this chop. We might get another retest down here, even if today's still a bullish day. Here, or maybe pre-market low. I'll be definitely taking some profits there if we get there. Still very early, it's only 10:40. Way too much in the chop. Pop chop thing. Gross. Is that your handle? No one knows. Like, I think it's day after a holiday. Dish down 1.2, but bouncing up there. That's 640 level. That's pretty good. Go down 4.8. Today is not exuberant with confidence. Market wants to go so much higher with phenomenal leadership. Yellen said that. Trying to get her calls to pray now. This is hideous, man. Ugh. Ugh. Hunter Biden algo. Jokes, okay. Sounds like something she'd say.
Trading. This analyst says the recently completed debt exchange and improving profitability could drive upside in Q3 and Q4. Thinks that the recently completed debt exchange could give the company at least 2 years of breathing room to execute.
Wow.
Also notes that Carvana is benefiting from more favorable industry pricing conditions, loan sales that are on pace to greatly exceed originations, and favorable pricing in the ABS market, while noting that Carvana has also made significant progress on initiatives that should contribute to sustainably higher gross profit per unit. But as for why this analyst isn't completely bullish and actually going into the buy camp, he says expectations that GPU, gross profit per unit, will improve by $600 to $1,100 versus 2021. That's what Carvana is currently expecting. That seems too high. And he also thinks EBITDA will come under pressure in 2024. So not actually bullish, but turning a bit more cautious on Carvana, and basically now in the majority of analysts, 70% have a hold rating on shares. The median price target is $45 a share, so this analyst has a $3 higher price target than the median, but it was giving a boost to Carvana shares, only seeing it up about a little less than 1% right now.
All right, so it's at least helping it stay bid at these elevated levels. Not exactly a big rally, but worth noting as the positive notes are coming in after its big run is held. You know, pretty amazing stuff. Thanks, Caroline. Carvana's a big comeback, still in favor with the market. Joining me for some thoughts this morning, Alex Coffey and Joe Mazzola here for a market meetup panel. I got Alex in the studio with me. We've been talking all about the Fed, of course, but we've got a few other central banks this week. Alex, get us started here. How do they factor into our macro discussion?
Yeah, it's more than just a few. You got the Fed, you got the Bank of England, you got the Bank of Japan, you got Switzerland, Norway, Sweden.
Oh, bring it on, baby!
The majority of these banks are basically within a meeting or two of the Fed. There's one exception. That exception is the Bank of Japan. All central banks, for the most part, with the exception of Bank of Japan, have been hiking and are getting to the end of that cycle. Be there one or two more rate hikes for some of them? Sure. Could there be surprises that change that trajectory? Sure. But the Bank of Japan is like just about to embark on this journey, and we've seen a different tone from the Bank of Japan. This has been the most notably dovish area of central banking.
Yep.
And the market is like eager for this to change. We've seen massive moves up and down in the yen. That's going to be the wild card for the week, I think.
How does that factor in, Joe? Because, you know, the dollar has just been trouncing everybody and everything in its way, even with these kind of historic shifts that have happened, in particular from the Bank of Japan.
Well, I mean, look, the upside surprise in the dollar, I think, has caught, some people off guard a little bit, and it's going to have an effect on the multinational corporations. I think we've seen a slowdown in some of the upside to the mega caps and to the market as a whole. I think
Coming back down to VWAP.
While the dollar story is important to me, I think it's a little bit more important to kind of keep an eye on the 10-year yield. Right now we're at about 4.33. I think it's at the top end of what most people would consider the range, but boy, if it gets above 4.35, I think you're going to start to see a little bit more headwinds really start to kind of hit the overall markets. I think that's the level where a lot of people think that, if we can get a pullback on rates, maybe get an extension of the rally, but if rates get above that 435 level, I think you're probably going to see some compression in the equity markets.
What do you think's holding us back there, Joe? How come there's been so much resistance to higher yields? I mean, does it have to break at some point in either direction? Could it be this week? Because how long can we just sit? How long can we just sit at the highs of the yield? I mean, that's what we're doing for the 2-year, 10-year, 30, right? I mean, everything. Just we're sitting there on the extreme.
Not only the 2-year, the 10 years, the yields, but we're also seeing the equity markets too, right? We haven't been able to kind of push back up above the highs that we saw earlier in the year. We're just kind of meandering around this level, and a lot of people can continue to ask, what's going on with the VIX? Why isn't the VIX higher? Well, part of it is because all these levels are just kind of consolidating all at the same time, so there hasn't really been an impetus to buy a lot of that protection. We are starting to see a little bit more of that now. We did see some additional put buying in the SPX, but I think what the market is really waiting on, it's not the Fed decision this week. 99% probability that nothing happens. It's really more the expectations
close some puts at
the November
VWAP.
meeting, and then really, in my mind, even more importantly, is going to be the dot plot, right? The SEP. As the Fed governors go ahead and project what they expect for GDP, project what they expect for unemployment, and what they expect for the rates in 2024. I think if that leans a little bit hawkish, meaning less cuts than the market's really expecting in 2024, that could provide that impetus to push back up above that 435 in the 10-year yield, and that might be that overhang on the equity markets that's been kind of just sitting there right now, waiting for some type of a catalyst.
Yeah, it's pretty amazing how comfortable we are at fairly high extremes. I mean, the one thing that there's no disputing is that crude oil is on the run. I mean, it's like on the loose here, Alex. They tried to keep it under control this morning, but it's already back to 92 bucks.
All right, I'm going to make a fun argument. I'm glad you brought this up because I'm going to make an argument that this hike, or not say hike, appreciation in crude oil can actually be more disinflationary than inflationary. And the reason being, look at the airlines. They're talking about more expensive fuel prices. Commodity and input costs are only inflationary if those costs are passed on to the consumer.
Yeah.
They're telling us they can't pass them on. They're saying demand's come down and that's going to weigh on their earnings. That is the last thing they want to do, but they simply cannot pass those costs on. You look at Spirit, they were talking about promotional activity. We've talked about that with places like Disney trying to spur demand during the holiday season and Christmas, which we know is like the most popular time for some of those places. And so when I look at something like crude oil and we look at CPI and PPI last week, we should have saw rates move higher. We didn't. So to me, that says we might see a short-term pop in inflation, but the market's not worried about it right now.
So we're gonna have to eat it basically. Well, the market kind of does. The crude oil move not getting passed on through inflation then would be kind of a recessionary kind of style of event rather than a pickup and pass through. I like that point. All right, nice. Good convo. Nice way to close it out there. Good macro thoughts. Joe Mazzola, Alex Coffey. Appreciate it, gentlemen. Trading 360 with Nicole Petalides is up next. Thanks for tuning in to Morning Trade Live. I'll see you this afternoon at 2 p.m. here on the Schwab Network.
Okay. Flipped again. I should have closed some puts at VWAP. Coming up on 11 o'clock. Got you close in 30 minutes. What you gonna do, Spy? Buy the day there. Starting to wick. Alright, I'm out of those calls. I might be done for a while. Down pretty good. I was doing it alright in the beginning. I was making little profitable trades and breaking even on the excess, and then got caught here a little bit. Just trying to be in the right position for once it breaks out, whichever direction that is. So, not a happy Money Monday yet. We'll try and see if we can pull something out for today. This count back green, but yeah, not really direction yet. AMC climbing back up to VWAP. Above VWAP now. GME also. So market looks, I mean, these stocks sometimes front run the SPY. So it looks kind of bullish, but it's just ugly price action. AMC right around VWAP there. Barba coding. BFS back up to VWAP. Let's break even. ACB, some more consolidating. Etsy down 1.7. SPY climbing back down to VWAP a bit. There's a VWAP test with SPY. GME above VWAP. 3.3 on that one. VWAP on SPY. There's still a short that could come about here. Could make a first cup still. Have to see it break some levels here though. Just chop around. I'm down 3% now on SPY. Or on GME. UGC down 14. Looks like it's just consolidating. Breakout on a firm there is up 4%. Too high, filling this gap. 586. Had quite the move since earnings. SPY right back up into the chop. GME's been climbing up above VWAP. All right, Mark, ready to take off? You back up to the high here. Wow. All that to break out to the upside again. Yeah. There goes SPY. And no. New high of the day on Les SPY. Teledoc broke through those supports. Yikes. Ugly. And SPY coming back down.
daily, and then looking at, well, again, daily candles here, you can see also breaking down below the shorter term 50-day moving average. Not as extreme in terms of the breakdown that we saw as far as Apple, but holding up above the longer term. No real lean from the RSI one way or the other. Again, a similar pattern here, Nicole, where we've seen some recent weakness, but if the bulls are still in charge in this longer term trend to the upside, you expect them to step up at some point real soon.
Right, understood. And so when you see this and you see it above the moving averages,
By the day they're on SPY.
I mean, that must at least give you some solace there. And then final one here,
Absolutely.
Starbucks today.
Yeah, pumpkin spice latte season. That's really what it is, Nicole. And there's an interesting stat behind that. Obviously, that's not the only reason for choosing Starbucks. They've invested in automation very early on, and that contributes to their expanding profit margins. However, something happens when the fall season emerges and this very popular latte comes to life. There is a lot more demand, but that's expected. And because the market's forward-looking, you'd expect that to be added into earnings. But a fun, very fun stat that I love about that. The Q3 earnings cycle for Starbucks, it's their fiscal Q4. That's on November 2nd. They actually have not missed their earnings since November of 2008. And I attribute that to the infamous pumpkin spice latte.
Oh, you see, that's good news. When you look all the way back and see that kind of historical data about not missing numbers, that brings some confidence to investors, at least that part of it. Ben?
Well, a similar pattern here in terms of the two names that we looked at, Starbucks in a very similar fashion, exhibiting some weakness as of recent in the more shorter term, but that longer term trend, it still seems like the bull's in charge and a key area, again, being tested at this point. Let's take a look, first and foremost, at the high conviction trade to the downside. Another perfect example of, again, that trend to the downside that comes into play. We're talking 120 down to around 100, but you can see a bit more sideways since, right? So kind of losing some of that momentum to the downside, but not necessarily rejecting this lower level. Got a lower extreme around 93 in this range that we've been, an upper extreme around 105, we'll call it. And let me just show you, as I went ahead and identified some of the areas of consolidation that have formed on the way down. Actually, let's just go ahead. I wanted to show you a price activity that we're seeing here now, somewhat range bound. Again, I mentioned that 105, the 194 lower extreme, and how 100 is your key area to watch here. That's because we're consolidating around this level right now. But as I show you again, with that 94 being the lower extreme, the reason that's significant is, well, we've tested this area a few times now, and you can see that it's held again around 94, 96, and you can see that now we're below the 102 area. So a similar situation in terms of what we're looking at with Apple, with Adobe coming off, and not necessarily what the bulls want to see in this instance, but as I take a look here, you're going to also notice here that this is an area where if they're still in charge with this longer term trend to the upside, they'd expect to step up at some point. You still got a little bit of room to the downside. It's 86 is a real line in the sand here in terms of Starbucks. Taking a look at where we are on the 50 to 200-day moving average. Again, a similar situation in terms of that shorter dated, the 50 testing or below. Much like Apple and Adobe. But take a look here. Starbucks is actually below the 200-day moving average as well. So RSI not really providing a lean here, but yeah, I guess a little bit more pressure on this one based on that longer-term moving average. But also want to point to, again, this being a key area of support right now. So if the broader market can rally here, if the bulls are still in charge, you'd expect them to step up. Another stock that's testing a key area of support here, Nicole, after some recent weakness.
Yeah, so it sounds like there's potential for bullish moves, but could go either way. Jessica,
Hi there on SPY.
Thought for this day.
Up to the pre-market high now.
We're just waiting on Wednesday. Wednesday is the big day. The markets are going to hold in place or jog steady, as I like to say it, until we get some indication of the data and the health of the consumer. So really, that's what I'm waiting on.
Yeah. All right. Jessica Inskip of Options Play, Ben Lichtenstein, thank you both very much for the big three on this Monday. Appreciate it. Coming up, we're going to spotlight what's going on with the auto workers strike, UAW, day 4. And where do they stand on the negotiations now that we're hearing also Ford could be possibly striking at some Canada plants as well. Much more coming up.
ACB's back to VWAP. It's down 6%. FFI down 6.25. Seems like it's still just consolidating. JetBlue's really been selling off. That chart. Highs there on SPY. Alright, coming up on the pre-market high. Got some puts there. Look for a dip, maybe grab some calls in. No, never mind. Look at that rip. Holy breakout. Wow. Tested that high for like a second. SPY's kind of squeezed right now. I lost my patience. Not wanting to take it after the emotional battle of the first hour of chop. Market 1. Happy money 0.
the strike. And I think that's where this is where it's going to get very interesting for both these companies. And Wall Street is going to Wall Street will continue to pay attention to this when this thing becomes more of a bigger strike as well.
As we look at this, you know, they're trying to go back, and I'm not siding with one side or the other, but I mean, part of it is that they are trying to go back to the days of yesteryear, you know, higher wages and pension and things like that. Does that fit in today's world?
It's a great question. The question is, does the automobile industry have a different business model than it would before? And I think the business model definitely has changed based on technology, based on what we've done before. And you can see what Rivian technology, you know, Tesla and Polestar, you have all these competitors have changed to it. So the model has changed. And so the question becomes, can they still be competitive to even international automakers as well? And that's part of the reason why I think you're asking me, and why I think there's got to be a better formula even when it comes to even supply chain costs and when you think of the margins. So we're going to start seeing this change quite a bit.
Yeah, and as we look at this, I mean, the last strike was about 40 days. And now Ford may actually, I know you were talking about it was 10 or 15% capacity at which, you know, they've closed specific plants, right? You know, Ohio and Missouri and
yeah, swing can work. It seems like a tough market to swing, just how choppy it's been the last couple of weeks.
40 days, I guess.
You know, not much direction.
I think people would
They're just
almost
consolidating, but
40 days.
it's worked for you. That's awesome.
For sure that would be the case, but you don't, right?
No, I mean, I think Canada was, I think, close. A couple of plants were close. I think today, the latest that they were thinking about going on a strike. But also,
it's more just
is trying to subsidize
the emotional exhaustion.
What they're saying to some of their workers. So that,
I'm just
to me, that would just
getting whipsawed in here. And once and I saw
able to do that. So I think for me,
signal to go long, I was just
it's a really tough
over it.
Actually hurts. Just, I mean,
since it was so many times false in both ways.
Going to have an impact should they not get together, and I don't want to think that, but I'm just hoping.
That's okay.
When you signal, when the government's trying to get involved this early, Nicole,
it broke that level pretty heavy, so that
maybe it's not, you know, it's a lot bigger than we think.
I wanted for my pets, but
at this point, I mean, they're proposing
I'll look to
wage hike
hold them for a bit
demanding that through
and maybe grab some calls.
Including an immediate boost of 20%. You know, and also the competitive landscape. I mean, part of the reason why they're doing this is because they're concerned that EVs and automation and that will take their jobs. But at the same time, the competitive landscape is so fierce. It's not just the big three anymore.
Yeah, and the bottom line, if you think of the numbers the last couple of years, obviously they've been year over year very positive, right? Costs have continued to go up in the supply chain.
All screen there.
The union deal, they struck that deal right before COVID, right? And so you think about the timing of all this and how it extended. The numbers obviously are very hard to, you know, for the big three. The numbers don't really match up for them, is what they're saying, to be able to sustain long term. And the question becomes, what does that number look like, and what does your business model change? And again, the big disruption here that people need to also pay attention to is the supply chain implications with this as well.
Look, and you know, over at Evercore ISI, you have the analyst there saying that he said this over the weekend in a research note that he foresees and expects plants that build the more profitable pickup trucks like the F-150s, the GM Chevy Silverados, Stellantis Ram to be the next strike targets. And in the meantime, Ford has already announced that it's indefinitely laying 600 workers off at a Michigan plant because of the strike. You had the Bronco. That's part of that facility. GM told about 2,000 workers at a Kansas car plant. I'm reading from a news report here. More and more layoffs are coming.
So, I mean, if you and I spoke last year, and I would say, well, what do I think the future of the automotive industry will be coming through the recovery of the economy, would be pushing the cost down. Yeah. Because we needed it. That's what the economy needed. We're actually going the opposite with the things that you just shared with me. Yeah. Thinking about the cost of these cars are now going to go what? Even further?
The ego on you.
People are worried about, and inflation has already hit the car market.
Well, yeah, and you think about when you can go on the lot.
Thanks, Fire Marshal Bill. Appreciate the gifted membership, man.
You know, then
Blue DJ landed on a rando. Your sniping skills have kind of waned a bit, Bill.
Great to see you, Ryan.
Sorry to say.
Thank you so much of Claremont Graduate University. Glad you're here to talk about the UAW
a little rusty.
strike. This is a huge story. Thanks for following up on that. All right, let's turn our attention to the IPO world. Another upcoming IPO is Birkenstock. How about another footwear that's been making some waves?
Thanks, Ace.
Let's talk all about it. Disruptors next.
I'm out of these quotes. We. Up, Cameron. A little rusty indeed. Blue DJ, you owe it still. Even though you're a lurker, you still owe it to Fire Marshal Bill. Thank the rest of you for your likes. Appreciate it. We're at 14. We had a European close 10 minutes ago. I broke out to the upside. We're 0.25% now.
Next month. But how about another footwear company that's making a move on an upgrade? Has certainly been marketing plenty, and that is Skechers. That is today's disruptor. George Sillis, senior markets correspondent, is going to take a look at Skechers for us today. George.
Yeah, Nicole, I mean, Skechers, I think most people are familiar with this brand. I mean, they sell everything from casual footwear, boots, shoes, sandals, but also making some headways into the athletic space as well as their traditional sneakers. But I think there's some interesting opportunities in the market, especially in the retail space. If you look at Skechers in the past about 5 or 6 weeks, it's been down, I think, in sympathy with the rest of the market.
I wanted a bigger
but there are
pullback.
some analysts that are they're rather bullish on Skechers, and I can see why,
I gotta wait.
considering the fact that the company's profitability is actually relatively
too red
sound
today.
compared to its 5-year averages. Some of the analysts, like for instance UBS last week, upgraded the stock to over $60, and even today Piper Sandler is upgrading the stock to overweight from neutral, and they increased their target to $59 from $54. They actually see some improving sales trends. If you think about Skechers, they've been very innovative, not only in their brand marketing but in their offerings as well. The other thing is their gross margin
Ripping some more
structure
there.
has really improved to close to 50% of sales, which is actually really good from the standpoint
We're getting
of
our
any
handle on this
retailer
big inverse cup.
or any apparel footwear
Not
manufacturer.
what we were looking for, but all
like
that chop this
Skechers.
morning.
But one of the things I did recognize when I looked at the financials for Skechers is that based on the trailing sales, they're about 12% growth. They're also expecting that in the next 4 quarters as well, with earnings growth about 14%, which is actually slightly below its 5-year average. But if you look at the forward multiple of Skechers, it's trading around 14 times earnings, where historically on a 5-year average it's around 21 times. So it's trading about 30% discount to its 5-year average multiple. And I think this is one of the reasons why a lot of the analysts have sort of picking through the rubble and looking for value-based opportunities. And I think they're onto something here. Piper Sandler is, as well as UBS, considering, like I said, if you look at the earnings growth at around 14% and its forward multiple at 14 times, its PEG ratio is right around 1, and anything below 1.5 times on a PEG ratio is considered fair value.
It's amazing how, Skechers sort of stays. It's just not going away, right? I mean, you think of Adidas and Nike, and they're just these behemoths, and everybody wants them. And Skechers is sort of this strange other group. And somehow it just keeps growing. They get famous people on. They did a collaboration with Snoop Dogg. They paired up with pickleball in the UK. They have slip-in sneakers. The commercials are endless. it's like they are relentless as a company. Just it feels like it's going to be here, till the end of time. Tell me a little bit about the chart.
Oh, sure. And I agree with you too. I think the company's done a great job from an innovative standpoint to market their brands, and also the merchandise mix is right where it needs to be. And I think
let's
that
keep
speaks
going.
to why the company's profitability profile is steady and increasing, and the stock is higher by 30% over the last year. But I mean, looking at the stock, if you look at like I said, the 5 or 6 weeks, it's been down alongside with the market, and we're kind of moving into that seasonal lull right before the Christmas shopping season or Q4, which is typically very good. So with that said, with the market being relatively volatile, and one of the things you may have noticed or may not have noticed, Nicole, is we're selling premium in the past few weeks because of the market volatility. So we're going to continue using that strategy here. And what we're going to do is we're going to go out to November with 60 days to expiration, and we're going to sell cash secured puts at the $45 strike, and that's about a 30 delta that we're selling, again, which implies that there's a 70% chance it'll expire out of the money. And by selling that 45 put, we can actually earn $2 in credit. So that basically puts, if we're assigned shares at $45, if it does hit that level, our cost basis is 43, which is about a 9% give back in price before we're at break even. But the whole objective here is to have time value erode over the next 60 days. And of course, the stock to hold the 45 or higher between now and expiration.
Yeah. Thank you for all of that. Really appreciate it. Good look at Skechers, our disruptor today. George Silas, good to see you. Thanks. All right, coming up, our panel is ready, looking at retail and Stitch Fix in particular. The earnings are due out later today. I want to hear what they have to say. So what about those pandemic highs, and now what? What can we expect with these upcoming numbers? Our panel's ready. Trading 360. We'll be right back.
Nikola broke out there. The day up 27%. Another new high on Nikola. Yo is also up 20 or 31%.
To the entire apparel industry. Even apparel is not declining at the rate that Stitch Fix is now. So that's absolutely an issue for the company, and how it gets out of this remains to be seen. It's probably a good target for an acquisition because there is a good database that I'm sure some marketers would be eager to get their hands on.
Yeah, you said it's the people who are time-starved, who might want to go to a third party. I mean, it's sort of like Rent the Runway. How do you feel about another name like that, Sucharita?
Yeah, I think that all of these services where you are targeting a relatively small percent of the population, an affluent shopper that is just wanting you to do some shopping for you, or in the case of Rent the Runway, kind of that you want to have some partial ownership of something that may be high end. The truth is that this is not the vast majority of the population. And what we've seen from the growth of companies like Shein and Temu is that people just want cheap stuff, kind of really inexpensively available to them. And that doesn't really describe any of these players that we're talking about now. The market opportunity, I think, for a company like Stitch Fix, I think it's just a limited number of people that really want that service.
So Stitch Fix, as you said, Tom, I think you have a neutral rating, right? The revenues are under pressure. You were looking coast to coast. So you keep this neutral rating. Is there any sort of bright spot when it comes to this name? Apparel certainly has been a little, precarious. Some people are into it, not into it. Do you have other names that you like a lot more that you do have buy ratings, Tom?
Yeah, so just wrapping up on Stitch Fix, I think my fellow panelists hit the nail on the head. Look, the performance relative to the broader apparel market has been stark. Clearly, losing market share, and I do think it's a niche service. So I do think they have a lot of heavy lifting ahead of them to inflect the business. I think some other businesses I like. There are a few footwear names out there that I like quite a bit. In your previous segment, you talked about Skechers. Skechers is a name that I like. I think they've got a great product trend happening right now, and they're a very strong combination of growth and value for investors. I would also call out Deckers, the parent company of Hoka running shoes and UGG boots. Great business, doing really well, strong management team, strong balance sheet. That's one of the higher quality names in my coverage.
Yeah, understood. Sucharita, as we look to the holidays, where do you expect to see some strength? Is it a type of store? Is it a specific thing? We're just talking about footwear versus apparel. Where do you expect to see some strength, Sucharita?
Well, definitely the brand manufacturers, and I think that Skechers and Deckers are good indicators of the strength in the brand manufacturing sector, and those companies that are able to sell direct to consumer, Nike and Adidas are in that bucket as well. The sectors that I am very wary of now, department stores. I think department stores have been challenged, and as we go into what's likely to be a rough Q4, I don't think that they're particularly well positioned. However, I don't think that you can bet against the mass merchants. The mass merchants are where people go to if they are stressed by inflation or high prices. And those are also the merchants that have been gaining share even through the pandemic, but they're also well positioned even when in uncertain economic times. So that's typically what I will have my eye on, is like those value retailers.
All right. Thank you both. Sucharita Kodali of Forrester Research and Tom Nikic of Wedbush. Thank you both. That's it for Trading 360. I'm Nicole Petalides. I'll see you at 2 p.m. Eastern Time for the watch list. Join me then. In the meantime, keep it right here. Fast Market is next.
Yeah, for that handle retrace, we could see all the way up to 446, 32, and be 50%. And we might get there before a pow pow. Kind of makes sense. Kind of right in the middle of the range, set us up. The inverse cup and handle, but if it starts to break, then broken pattern. I can keep going up or chop or do whatever. GME testing VWAP. What's off of it? All right, SPY hanging out the highs here. Consolidation. I think it's made its high of the day yet.
Lagging down about 0.2% to kick off the trading week. To help me break down this,
see if we get a nice pullback re-entry before we do make high of the day.
Mild start to the week. Not a lot of data today. We had housing market index that came in a little bit light, but I think all eyes and expectations are for the Fed announcement on Wednesday.
Yeah, the thing on the calendar that jumps out at everyone is the Fed meeting that we're going to learn the term summary of economic projections is what we're going to, that's the one that's going to make the big news this week. But slowly but surely, Tom, there's another story forming, which is crude oil.
Yeah.
And what I said with Oliver Rennick on this morning is the market can rally with higher rates. The market can rally with a higher dollar. The market can rally with higher crude oil prices. What the market doesn't like is spiking. Any of those three spiking is what they don't want. And now crude oil moving from, August 24th, I have it trading 78 and change. Right. And we were worried about it then. Well, it's significantly higher now. And that chart from there to here, the only thing working against crude oil right now is it's extremely overbought. Besides that, the fundamentals say higher.
Yeah. And the production cuts in Saudi Arabia, OPEC Plus nations kind of pulling back, extending those production cuts in through December. There's rumors that they might extend them into 2024 also. I just wonder if demand's going to be a concern with crude oil prices where they are, with fuel prices where they are heading into the winter.
The question is how much does Vladimir Putin have? How much power does he have over OPEC, the regular OPEC? Mm-hmm. Because he's fighting a war that's extremely expensive and it's going on a lot longer. What is his influence on OPEC?
Yep. We're going to find out more on crude oil as we continue through the week. But the big story over the weekend, talks continuing on the UAW strike against the big three automakers. Let's bring in Caroline Wood, senior markets correspondent, to give us an update on this. It didn't seem like much happened over the weekend. I saw Stellantis came out and upped their offer to about 21% wage price gains here, Caroline. Anything else sticking out to you?
Hey there, Tom. Well, first, I think it's important to take a look at shares of GM, Ford, and Stellantis because they're under pressure today as this strike continues for its fourth day. GM off 1.3%, Ford off 1.7%, Stellantis off a little bit more than 1%. So we didn't really see the stocks get hit much last week when the strike actually, when we were, very much expecting it, and then at the strike of midnight on Friday when it actually hit. But we are seeing some weakness today. Of course, it's been pretty the impact has been pretty minimal at this point. It's 3 plants in Missouri, Michigan, and Ohio. It's 13,000 workers on strike, which is a fraction of the 146,000 workers that the UAW actually represents. But we are starting to see the spillover effect that we talked about late last week. For example, Ford had to lay off 600 non-striking workers at a Michigan plant because they were directly impacted by some of the workers that were on strike. Also, GM said that they may have to do the same thing with 2,000 workers at a plant in Kansas. Basically, they'll have to be out of work until production resumes. GM also said the strike at a Missouri plant will cause a part shortage at another strike at another plant in Kansas, which could lead to that shutdown, or to the shutdown of that plant. Meanwhile, we're also hearing that Unifor, which is the union that represents automakers in Canada, is preparing to go on strike against Ford. tonight at midnight. So we are starting to see the spillover effect. As you said, we know the UAW resumed negotiations with the Big Three over the weekend. However, UAW President Shawn Fain told NPR today that there were minimal conversations and the ball is in their court. He says, we have a long way to go. So it doesn't seem like they're making a lot of progress. They did reject a 21% pay increase from Stellantis. The automaker called the offer compelling, but the UAW said it's definitely a no-go. It's basically similar to what both Ford and GM have also offered, but the UAW is looking for more like 40% wage increases on top of a shorter work week, a 32-hour work week at 40-hour pay, as well as job protections and retiree benefits. UAW President Shawn Fain did tell Face the Nation on CBS over the weekend that if the union doesn't get better offers, then we're going to amp this thing up even more. So basically saying that they could expand the strike to even more plants that could create some of the more highly profitable vehicles. We've also heard some of the politicians weighing in. President Biden, of course, who considers himself the most pro-union president, said, you know, basically the companies have made some significant offers, but I believe they should go further to ensure record corporate profits mean record contracts for the UAW. Nancy Pelosi has said that it's just unjust that CEOs are making more in 1 month than some workers make in a lifetime. We also heard from Bernie Sanders saying the CEOs and stockholders on Wall Street have to understand they cannot have it all. So you know, definitely some pressure from the Democratic side, but you know, we are seeing it reflected in the share prices today with all three of the Big Three off more than 1%, although really haven't seen a huge impact on shares quite yet.
Caroline, it sounds like they negotiated with Ford on Saturday, GM on Sunday, Stellantis today. You know, I am the union representative for the Fast Market team here, and 21% pay increase and 4-day work week, we vote yes, Caroline. I don't know about you. Would you like to be part of our team? Because we vote yes.
Well, Shawn Fain would say absolutely that's a no-go. That's what he said about Stellantis' offer. And I think the other thing that you have to consider is that it's not just a 21% pay increase in terms of wages, because they actually want shorter work weeks as well. So if they're paying 40-hour work weeks at the 21% raise, or even if they end up negotiating on a little bit higher, it's actually quite a bit higher if you factor in that they'll actually be working less hours and could potentially have to bring in additional workers because their workers are working less. And this, of course, comes at a time the politicians are very focused on the record profits, so is the UAW. But these Big Three automakers are trying to ramp up productions of EVs all the while while turning a profit on those. And so this could just, you know, they're already at a disadvantage in terms of labor costs even before these negotiations. So these could result in huge labor costs for the Big Three as they really try to, you know, navigate the EV waters, which is why so many of the analysts are saying that Tesla is really the beneficiary of this, based on the fact that they're already doing it cheaper and they're doing it with non-union labor. That being said, Tesla is also under pressure today. Shares are off about 3%. There are those reports that it could build factories in Saudi Arabia and Turkey, but it's not doing anything to boost shares today. So Tesla's considered the beneficiary, but we aren't seeing that reflected in the stock price either.
Yeah, Elon Musk just came out and stated that the fabrication of the Wall Street Journal story on building a plant in Saudi Arabia, he said that's completely false. So yeah, and to go into negotiations, the auto, you know, the labor union, 32-hour work weeks. They're trying to cut that down. And as Caroline mentioned, that means they'd have to hire more people at that elevated wage rate. I see the automakers pushing back on that and just saying no, absolutely not, cutting the work week. But
I have nothing good that I can say that's going to add to this conversation other than I would have voted yes.
Other than we need to unionize.
Yeah, exactly.
Another time, let's talk about that. All right, thanks to Caroline Woods, senior markets correspondent here, breaking down the UAW strike. Now let's bring in Alex Coffey, senior equities contributor here. Alex, I kind of wanted to get your take here on the markets. It seems like specific asset classes, whether it's yields, whether it's the dollar, whether it's crude oil, are all playing a part in maybe some of the headwinds that we saw last Friday, earlier in today's session for the equity market. What's your take here on that?
Yeah, I think on the calendar, the bank that has the chance to make the biggest splash in terms of central banks is the Bank of Japan. Right. The influence on the trajectory of the dollar is greatly influenced in terms of dollar index by the yen. Basically, all of the central banks are approaching the end of their policy tightening cycles and are looking for a place to hold. Where Japan is kind of in the beginning of embarking on this journey, if it's going to ultimately do that.
Well, yeah, they ignored it for years. They didn't do anything.
They've been trying to get inflation for 30 years, and they really haven't.
Right.
So they've propped up their economy largely through spending and fiscal policy. It's just, hey, different ways to approach things, I guess, is the way to think about it. But there's appetite right now for a move off the kind of ultra dovish stance at the Bank of Japan towards something a little bit different, and we'll see if that ultimately takes place. You mentioned crude oil. In terms of inflation and crude oil being a big part of that story, I think I can make an argument that ultimately crude oil in the increase in energy prices is going to be more deflationary than inflationary. And the reason I say that is we've recently gotten airline updates talking about how fuel prices are impacting their bottom line, not talking about how they're passing those costs on to consumers. Ultimately, for CPI and consumer prices to go higher, costs have to be passed on. So what we're seeing now, at least in some industries, is more about margin compression. Throw that into the fact that the actual move in crude oil is largely more of a supply-driven move. It's been more outputs being cut, and also the type of crude oil that's kind of coming off the market is more that heavy crude oil, which is a little bit more tied to things like diesel fuel. Right. And of course, that means choices have to be made. And so I look at all of this combined with the fact that we didn't see much reaction at all in interest rates last week. The market's not seeing this like entrenched runaway inflation to the upside. In fact, they're looking at this and saying, the market as a whole is looking at this and saying, yeah, CPI is a little bit elevated. It has bounced back, but these forces are actually going to have a dampening effect on the economy, not the reigniting effect that we've seen in different inflationary times.
Yeah, I like that angle that Alex brings up, Kevin, and because you've got these rising oil and fuel prices that are pressuring the consumer. They start pulling back on things. That's not inflationary at all, right? And then you have to, margins will shrink on the corporate side also if people aren't buying things. But the consumer's been pretty robust. Yellen, she did an interview today on CNBC. She said no signs of the economy in a downturn at all. Lower inflation's taking place. So she said some positive commentary.
Remember, she doesn't work for the Fed anymore. She works for the administration. So you're going to get a rose-colored glasses view of the world. But, Alec, I've had this discussion before with people about what higher crude oil prices do to overall inflation. And because, remember, the definition of inflation is more dollars chasing fewer goods, right? Well, if you have $100 a week to spend and you were spending 30, now you're spending 50, you have less money to spend on other things that could actually work against inflation, not accelerating it. So there is a counterintuitive argument to have about inflation and what higher energy prices do, because it's not like it's discretionary. Right? Crude oil, you have to put gas in your car. If you work, if you drive somewhere, you have to put gas in your car. That expense goes up or down just by the price of crude oil, really. So I agree with that completely. You could make a case where it's the other way against inflation.
Yep. Yeah, that might be the concern because the consumer has been holding up the economy pretty steadily. But Alex, when you look at individual names, I wanted to kind of pinpoint Apple here. It's getting a little bit of a bid. On the back of there's reports out of Morgan Stanley came out with a note. Wedbush came out with a note that says that pre-order data better than last year with the iPhone 14. You're starting to see Apple catch a little bit of a bid after kind of wallowing after the product release last week. But it seems like the data is there to support the fact that, hey, this upgrade cycle is actually going to be real, because they said the same thing last year, these analysts, about Apple's upgrades for the iPhone 14 that didn't really pan out. But that was a supply issue during the holidays. They didn't have enough product because of the lockdowns in China as far as production goes. But this seems to be pretty good data coming out.
Yeah, I can't speak for anybody else other than myself in this, but Anecdotally, it certainly seems that the iPhone is no longer discretionary. The upgrades, like I'm not even on 5G yet. Like my iPhone is like 3 or 4 old, and it works just fine.
Right.
And when I was younger, when it went from the iPhone 3 to the iPhone 4 to the iPhone 5, each time it was notably different. You were at a disadvantage to your peers if you didn't get the newest phone. I don't think it's there anymore.
Yeah.
I haven't been able to tell a difference in the camera for like 7 iPhones. I know it's getting better, but that's not my thing. And
yeah,
so,
you're not out there taking pictures. And
I looked at
even
TTO.
if I am, I think that the phone that I have has a serviceable camera. Now, look, I could just be getting older, and technology maybe isn't as interesting to me as it was. But what I guess I'm getting at, Tom, is you're going to upgrade your phone when you need to now, not when you want to.
Right.
And they're going to have a stable amount of iPhones that they're selling, but it's not. Every year you need the next model, and that's okay. It's a proof to the phones are getting better. They're lasting longer. They're more durable. Used to break the phone every time you drop it. Now it survives a couple drops. At least I've seen. So I look at this as Apple's stock as a
resistance
company
at 45 cents maybe.
From
It's up there.
individuals and companies and institutions. People trust Apple.
The trigger for this one would have been some golfing candle on Friday.
Here today. I think
all
you
that
see
volume.
buying an Apple in the near term if the market holds
increased
in here,
volume.
just simply because it's
Had
Apple,
support.
not necessarily because the iPhone data
hard
has
to
been
know that's going to
strong
do
or
this the
not
next
strong.
day.
Helps a little bit to have that.
It's a bit of a
story
chase now unless you're
alongside it,
scalping
but
it.
This is a name that investors over the years have looked for opportunities to buy despite bad news. And so if there's some good news too, that's great.
Yeah.
It seems like the dividing line between a recent iPhone and an old, if you still have a button
at the high.
on the bottom of your iPhone, you are officially in the old phone camp.
That's true. The stock's getting a pop here today, nearly 2% jump, but it did have some trouble last week after the product release was announced. Kevin, real quick here before we go to break, what are you focused on besides the Fed this week? Alex mentioned the other central banks, Bank of England and Japan on Thursday
Both
and Friday.
Thursday morning, Thursday night. It's like 7 a.m. Eastern for the Bank of England, about 10 o'clock Eastern for the Bank of Japan. Remember, Tom, in our career, the yen was a big driver of the U.S. dollar, and it's kind of lost its relationship with it. So if that starts to reignite, that's important. But I still think it's the dot plot. That's the projections for GDP, for inflation, for unemployment going forward for 2 years and beyond. I think that's what this market's going to key off of this week.
Yeah. I'm going to focus on the yields because I still think the bond market's going to be driving the equity market at this point. We've got the 10-year yield just above 4.3%, so continue to watch those asset classes. All right, let's take a quick break. When we come back, we're going to take a look at Amazon. Stocks up over 65% so far this year, hit a 52-week high just last week. Fast Market's coming right back.
back down to VWAP. Down 3.5. Nickel tested high there. Grab a couple puts on SPY. Nice, Sergeant. Well done, man. Go down. SPY's ripping back up here. Little head and shoulders just failed. Barbecue is up 5.5 in its range between 19 and 16. Oh, TTO supposed to reverse split soon, huh? Pre-reverse split squeeze. Come out with sepsis medical treatment. Hoping to get their FDA approval.
So,
right.
The one caution I would kind of throw is that as they start to step into more and more areas, we've even seen this with names like Apple, the likelihood of making a misstep increases. And if you start jumping into, producing movies, for example, it might be successful, but just because you have a really successful e-commerce business doesn't mean that you're going to be successful at making movies, or running a cellular service if that's something they do, or whatever business that they go into. Now, Kevin makes a good point. I think largely the Amazon Prime and sort of the disruptive approach to Thursday Night Football and the broadcast for NFL has been well received. And so in some cases, you can also succeed, and you can get more reasons for advertisers to come in and people to join Amazon Prime.
Cosmo Kramer up 20%.
I look at this as it's a double-edged sword. Success can be a great thing, but there's a lot more opportunity for missteps the more they put their technicals into other things.
Yeah.
And one last thing about Amazon. We were talking last week about how NVIDIA's PE and ARM Holdings PE, 111 PE in Amazon.
Yeah.
Yow.
Yeah, valuations
Not exactly
are up there.
cheap.
And then that was the reason for the slide last year. They said valuation and then the pullback in the consumer, but once they started cutting headcount, and we're not seeing a re-acceleration in the cloud business, but their margins are still pretty robust. Margins actually grew on the e-commerce side of it, which is always helping that re-rate that I think analysts are giving it. But Alex, you got they report earnings on like November 2nd. So how do you want to look at this from an example trade?
Yeah, along the lines of valuation, you could make an argument that it is still on the underpriced side because forward PEs are actually on the lower end. That, of course, requires them to actually meet the earnings that are being projected right now by the street. So if you have maybe a more sour view of the economy going forward than the street does, you could say that Amazon might be more fairly priced. I looked at this just solely from a volatility and price standpoint, Tom. I selected a bearish strategy. You can make the argument for the bullish or a neutral strategy in this same light. But implied volatility levels have been basically understating the actual moves that we've seen. So while implied volatility is at the 17th rank, when you look at that on a percentile basis, it's still understating. So I could still consider it low relative to the movement that we've seen. We've started to see the overall market seem a little bit more shaky as yields have accelerated, as crude oil has gotten higher. And of course, we have central bank activity on the horizon. So I looked at a buying of a put calendar. So this is a bearish strategy. The primary reason I did this is if I'm looking for an increase of implied volatility, I'm much more likely to get that in a down move than an up move. Although tech stocks sometimes can be the exception to that rule, and Amazon falls into that camp, of course. But looking for both an expansion of implied volatility and a downwards move in the stock towards 125. You can see the strikes selected are both in October and November, and the dollar. What dollar?
$60
debit. Yeah, $1.60, $1.50 debit in that camp. Looking for that as the risk. So trying to control the risk, keep it small. Jenny and I described this strategy as sort of throwing a dart, and it's more about precision in that target price than it is direction, because this stock crashes from here, you're going to have risk to the downside as well. And so I looked at the chart and I'd seen that the stock had sort of based out and had found support around 126 back in late July, early August. And so looking for a retest of that level, an expansion of implied volatility, those would both benefit this strategy as a bearish look in Amazon.
Yep. Let's break this one down. Going out to November, so you're giving yourself duration on this one. Also,
coming
Alex,
up again.
monthly on November 17th. Buying the 125 put, selling that same 125 put in the October monthly series that expires in 32 days. You're paying $1.60 debit. There's your risk. $160 per spread, but your break evens, Kev, on this one pretty wide. Just below 118 on the downside, and just above 134 on the upside for this calendar. And because you're going to have that earnings in there, you do have the potential when you're rolling or adjusting this trade to get some pretty decent credits if the market's open and liquidity is provided.
Alex Coffey is such an old soul
on
this show. You know why? He did 2 monthlies for a calendar spread. He's out 60 days and his short is out 30 days. So what does that do? The trade-off there is it gives you a lot of time.
Yeah.
It gives you very low premium that you paid for something 60 days out.
Right.
You've got a lot of time for this to make a move. And Tom, as you know, because of he's 60 days out, it gives you a fair chunky amount of Vega if volatility picks back up. 9 delta short with about 8.25 Vega. 8.25 Vega is a pretty nice for one spread. Yeah. I mean, if you get a couple points uptick in implied volatility, that's a windfall there. But yeah, it's the 1 month and the 2 month options, not using any of the weeklies. That's like old school stuff.
Old school, and it's the strike price that Alex used in this example, $15 below the current share price in there. That's about what the November move is based on the option pricing.
And look at the beta. on Amazon, about a 1.2 beta, which means if the market moves downside, this will move downside more than the market. Remember that. That's what that means.
And that beta can be dynamic also, so you got to keep that in mind. You do have some assignment risk on that short option over the next 32 days going into expiration, but a downside bearish put calendar that Alex brought us that pays off pretty well on a risk-reward basis if it gets down between those break-evens that we talked about. All right, thanks to Alex Coffey, Senior Equities Contributor, for joining us, breaking down markets. Coming up after the break, Kevin and I are going to be joined by Megan Brantley from Likefolio for discussion on Carvana and the data on the stock moves. The used car company has seen its stock skyrocket this year, nearly 1,000% upgraded today. Stick around, coming right back.
High of the day, they're on SPY. Wow. A lot of volume on that spike there. There's 50% on TTL.
5% year over year. But I think more concerning is the fact that Carvana is underperforming its peers. And so whenever you look at these web visits for a name like a CarMax and an AutoNation that have more of these hybrid sales experiences, they're actually showing improvement where you see a decline for Carvana. So, that's the first red flag that we look at. And then the next place we look is we look at consumer happiness. And this tends to be our best long-term indicator. And when you look at consumer happiness for Carvana, it's around 55% positive. And that's low even by our standards. And more concerning, perhaps, is that we find Carvana again in the bottom of the pack whenever we look at some peers, especially in auto sales. And a lot of consumers are talking about, they're missing some of the perks of the dealerships, the repairs, the tune-ups, just having someone to turn to and somewhere to go whenever they have a problem with the vehicle, which those problems, reported problems are rising. So I think that spells trouble as well for Carvana if consumers feel like they can't trust the platform. And so just the combined web traffic, continued decline, and the relatively low consumer happiness scores give us reason for concern whenever we look at Carvana, and especially how much it's run just this year.
Megan, I agree that the long-term views of this company are troublesome, right? They've got big debt load. They've got issues. They just refinanced a bunch of debt, but they had to dilute more shares to do that. But this stock, I mean, they're not out of business yet, right? I don't know where they're going to be, but they're not out of business yet. And this stock jumped last week on the retail sales data because it was such strong for cars. And you can make a case that a UAW strike is good for used cars. And as long as you don't look out too far on the horizon with them and they just win short term, this company's got a shot, at least, to stay in business as long as they keep working on the debt. And, it's interesting. All these companies, CarMax, what was in there too, Megan, they all suffered during the pandemic because of the volatility with pricing. Don't they benefit from more stable pricing, buying cars and selling cars, marking them up slightly, getting volume in the door? Isn't that what's going to lead them back if they make it back at all? I have no idea they're going to make it back because that debt load, Megan, is a big one.
It is, and that is true. Like, this certainly is still a viable business. However, we're looking at this too from I guess a longer term lens and even an earnings lens, and we see a little bit more flashing red just in terms of how the consumer is engaging with them, because that's really where we're specializing here. And a lot of these macro headwinds, when you look, I think that the used vehicle market still has a hill to climb. You've got continuing, pending the UAW strike, new vehicle inventory improving, and you've got used vehicle loan rates that are still sky high. Whenever you look at the average loan rate for a new vehicle, I think that's between 5 and 14%. For a used vehicle, that's between 7 and 21%. And so we continue to see that weigh on the consumers. And then we also saw signs, I think last month, for the first time, used car prices are falling again, and that could cut into some of these profits. So I think that there are a lot of macro headwinds at play as well that Carvana may have to overcome into this next quarter. And I think that the recent run just makes expectations even higher that investors are going to start to expect these improvements and these turnarounds, especially in its underlying business model. And we just don't know if the consumer demand is there enough for us to make a bet to the upside for this name.
Yeah, they report earnings early November here, Megan. So we've still got some time. I mean, if you guys have an earnings score on something like this, what would it roughly be?
So we're in the neutral range right now for Carvana, but we're in the really low range of neutral. And I think that considering just how shares have performed near term, that sets the expectation bar a little bit too high for us to bet to the upside. In fact, we're starting to watch for if we had to pick a play more to the downside.
All right, great stuff. Great data as always, Megan. Appreciate it. Have a great day.
Thanks, guys. You too. All
right, that's Megan Brantley breaking down the data on Carvana. Kevin, I saw a stat here today, and I'm not sure if it's completely accurate, but we all know the basic story behind this and maybe a lot of the moves. They've got a 30.5% of shares outstanding sold short, which accounts for about 45% of its publicly
big short
traded
interest. Hard to borrow.
Hard to borrow.
That's a dead giveaway that there's some big short interest is the fact that it's hard to borrow.
But, and, you know, S&P Global Ratings raised their issuer credit rating on this company from a D to a C plus.
Here's why. They just refinanced a bunch of debt, and they were able to retire some of it and lower the interest rate on others. So all
I
that's
wanted to
good
almost
news.
even raise
They
earlier.
still have a bunch of it, though.
Yeah, and
right? They still
S&P,
need to make money on a daily basis. They need to get profitable.
S&P, after that ratings change, they did continue with their negative outlook on the company. But this is one of those names, Kevin, that we talk about where you've got a big short interest thing. It can move not on fundamentals.
Nope.
So how do you want to look at this from an example trade?
Well, I have literally 3 different trades that you can do on this.
These guys have awful hands.
You know, you look at a 1-year chart on Carvana, you look at a 3-year chart, this stock traded $376, right? It's down to $50, and it was, like I said, I got the low $3.55 on this. So it's been all over the board, but if you get a winner, if they make it back, you could be a big exponential winner, but there's risk, right? So you could do finally the paper money practice trade that I looked at was just a call calendar to the 60 strike, something very short term, collecting a fair amount of theta because implied vols are high. But you could do the long iron condor time. You could do the long dated vertical spread, both up and down. You've got a ton of options here to do in terms of strategies, but you gotta fit the strategy to your opinion. Right. Remember, this trade that we looked at here, this paper money trade, the October 6th buying, the October 6th 60 call, selling the September 22nd 60 call, that basically pays, that's almost neutral. You know, even though it's, you know, what is it now?
$8 out of the money.
It's basically almost neutral. In this, it's neutral to bullish.
I was trying to slow play me a bit.
I mean, the delta on it is 15, almost 16, but
a lot of other outs.
You're collecting a fair amount of theta, which means if you get to extend duration, it's trading about $1, right around $1.50. We had it priced higher. The stock has backed off. But this is just something to collect theta because you've got high implied vols while you look for small moves in this stock.
Let's break this one down. Buying that October 6th 60 call, selling the September 22nd, that expires in 4 days. That same 60 call, $1.60 debit, $160 per spread in risk. But as Kevin mentioned, this is like a slightly neutral to bullish type of example here because your break evens are just above 52 and all the way up at 70 on this one. Now they have earnings coming up, I think, in early November 2nd. So you got to keep that in mind. But this one expires in 18 days, the long option that you bought. You've got that wide break even where you can potentially be profitable on this one. You have some assignment risk on that short 60 call into expiration over the next 4 days, so keep that in mind. But this is an example trade when you're looking at a stock that maybe that doesn't make sense when you're looking at maybe directionally and goes against a little bit of the data from Likefolio, but we've seen what the stock can do. It's up nearly 1,000%.
Look what it did on the retail sales data. It's shot up.
Right, based on the back of used car sales starting to improve a little bit. But good look at this example trade here, Kev, on Carvana. Inexpensive way to play to the upside on a slightly bullish tint there. All right. Coming up after the break, we're going to take a look at Micron. The chip maker was upgraded today, and stock has risen over 40% so far in 2023. Fast Market's coming right back.
GME bounce on VWAP. There's a gap up there at 1821. Shared victory. Should put them all in. Whoops. Jeez. I don't think I'm gonna get this guy that not call. Yeah, with a 6. He would have called with that too. Buy at the high. Sort of. Consolidating up here, it's up 0.3%. What the heck? Get a higher full house? It's supposed to be expected when he's calling on those queens. Jeez. You guys are wrecking me.
57%, and their EBITDA was down 79%. But I think
Slow played it there.
Situation
That's
where
crazy how much I can wreck you.
Moving higher based upon expectations of a cycle of refresh and higher demand.
I guess I didn't slow play
as
it.
well as moving off excess inventory. Deutsche Bank actually increased their rating on the stock to a buy
play it the same as when I was bluffing.
They've got an $85 price target from 65. And they actually see two of the tailwinds associated with inventory
He slow played it on the river.
I think there's also, in my view, a computer or a server, if you will, also
He hit the nuts, right? Highest full house
that we're probably going to be seeing in the next
Crazy.
year or so. Then artificial intelligence. I mean, you can't have artificial intelligence unless you have DRAM chips or dynamic random access memory chips for computing. And so I think that is another catalyst that's embedded behind Micron Technologies, alongside the increase in, of course, computer demand, which I think is going to improve the CPU demands alongside companies like Intel, which, if you look at that stock as well, has been performing nicely this year.
George, this is a PC and a smartphone story, isn't it, with Micron? PC shipments, first quarter 2023 shipments down 30% year over year. Smartphone sales down 15% year over year. they get a recovery in those two things, like you said, we're now, what, 3 years into a cycle where people are going to start changing things out. If they get a recovery there, is that why they're getting some upgrades here?
I think so. I mean, I'm just going to say, look at the price performance of the stock relative to last year versus the financials, which I mentioned, in the last 10 years, they had the worst 4 quarters combined, the last 4. First half of 2023 and also the back half of 22 is really bad for Micron. The stock really found a bottom, around the October period where the market did as well. So I think there's really an element of the demand associated with servers right now. I think that is the backbone for artificial intelligence, which people sort of miss. Computer demand is going to be higher, as well as, I think, smartphones. I think all of these things are moving together, are lining up for Micron, which are going to be positive for not only reducing inventory, improving average selling prices, but there are some hangups you have to consider too, because there are some export restraints on memory chip manufacturers like Micron, which is a U.S.-based company, but 52% of their sales in the United States.
Oh my gosh.
And also China. China is also implementing some cybersecurity concerns with the iPhone, maybe Micron. And Hong Kong and China
barely didn't get there with diamonds. I got lucky.
Either directly or indirectly through third parties in that area of the country. So Hong Kong and China.
That was a good raise.
You have to keep in mind
good raise I
Micron.
did.
But
had to put the pressure on before he landed anything.
If you look at the DRAM suppliers globally, Micron is one of the 3 largest. The other 2 are the Koreans. Samsung and SK Hynix are the other 2 major suppliers globally. So there's only 3, and Micron is certainly one of them.
Better raise this a lot before someone gets a higher.
They did see AI servers, as they start ramping that up, they're a little bit behind the company stated. But AI server requires 6 to 8 times the
Such
DRAM
a strong
content
raise. I don't
triple
know.
the NAND content of a traditional server. So I think maybe that's why you're seeing a lot of the expectations getting hiked here for this company moving forward.
Guess you could have a 4 and a 6.
Great stuff, George. Appreciate it. That's George Tillis.
Better slow down here.
Thanks, George. Breaking down the Micron for us. Kev, so I looked at this.
No, then the ace wouldn't connect.
At or near 52-week lows in
Micron,
the IV percentile rank,
what
about
the
16%,
heck?
so at the low
aces.
end of a range. So I looked at a strategy. If you believe this Deutsche Bank analyst, Sidney Ho, that came out and jacked up the price target to 85 from 65, this type of strategy takes advantage of it. But I went out in duration, Kev. I went out basically 88 days till expiration and looked at the December monthly cycle, buying the 70 strike call, which is basically at the money. And then
my check there was great. Great little slow play into the river.
Here. Sell the 80 strike call against it to offset some of the costs on the purchase of the 70 call. $10 wide bullish call vertical. Kev, you're paying roughly, we've got 360 debit on here. Stock has moved up a little bit, trading closer to 380. But if you pay a 360 debit on that, there's your risk, $360 per spread. Break even, 73.60. Over the next 88 days. That's only about 3.5 to 4% above the current share price, so you don't need a big move. But Kev, I looked at this this vertical in the December cycle was trading 360. Right now, the same call vertical in November is trading about 360. The December is probably trading closer to 380. But look you're only paying 20 cents more basically for that same vertical while giving yourself an extra month. So I kind of wanted to bring up that angle also.
You've got 88 days and you've got almost 31 deltas. So this is just a bullish play. It's along a little bit of Vega, but not any significant kind of Vega because both are in the same. But you are long December options, so there's going to be a little bit of Vega component in there. But like I said, this is one, if you buy it around 3.5 or so, 370, you almost a triple if it goes the right way. So you're looking for a move recovery. Remember, inside what they said, their price target of Deutsche Bank is 85. So you're along the 70-80.
Yeah, and that's typically a 12-month target that those analysts give. But, people will say, well, why don't you just buy the 70 call and hope the stock goes up? Well, it'll cost you more because you're not selling anything 20K against it. But at the same time, you'd need more than a 13% move over the next 88 days to get above 80. So you're being a little bit more conservative, but the risk-reward setup's still pretty good on this one, Kev.
There's always the chance that it could
go
infinitesimally higher.
Yeah.
It's just low probability.
Yeah, exactly. Working on probabilities, offsetting some of those initial costs in there, but definitely a directionally bullish $10 white call vertical to the upside. All right, that's going to do it for Kevin and I today here on Fast Market. But stick around right here on the Schwab Network. Next Gen Investing is coming up.
Next Gen I. Still hanging out up here. MACD crossed over on the 5-minute bear side. If we get a move back down at all. I think it could have hit his high right here. High of the day. All these straights, man. Just re-raise? Come on, guys. Always minimum re-raises. Nicola's still going? Yeah, new high there on Nikola, 35%. Got a gap fill up at 1.9. That. Pair of sevens. Oh, 7 jack. Oh, okay. Slow it down a little bit. Gotta look out for clubs here. It's also a straight, maybe. Raises. I'll just call. These min raises are silly. See, I'll just straight. Dang. Just slow play it. Flush didn't get there also. A re-raise. Nice. You didn't have anything till the river? What the heck? Guess I could have re-raised more if both those guys called. I really thought I had nothing. 29 shares of AMC is red. Yeah, AMC's chart doesn't look too good right now. I broke that trend line, and it has its head and shoulders. So we'll see. Needs to find some support. Neckline at least 7.5. Otherwise, we're just looking at a bounce and a larger downtrend. How much do they go up? 100,000 with King 10. Congratulations.
Because we had some fun end of the sessions at the end of the week last week. We don't have that today. I think it's probably, as you mentioned, largely due to the fact that we got central banks everywhere and always in the second half of this week.
I could not echo that sentiment more. It was a very challenging morning to get up on this Monday. But as always on the show, we'll be focusing on the individual equity movers.
They merged with a Canadian company this week?
Vote and downvote segment. Following that, we'll chart
I didn't know that.
those upvotes. And our FOMO name was all of the rave towards the end of last week. That was the ARM IPO, which is seeing some pretty sizable selling today, down almost 8% now on the session. And then we'll discuss
climbing
retail.
up here a little bit.
Sort of the broad theme of our focus today. We'll be discussing
ARM back at the open.
Downgrade out of Piper
Go
Sandler.
open.
We'll also be looking at our loan earnings play today. That is Stitch Fix ahead of their quarterly update today after the closing bell.
Yeah, retail is such a broad sector, of course. We're even talking more particular now. We're talking apparel retailers, I would say. But even then, amongst those retailers, amongst those apparel makers, there is such a wide variety of performance right now. It's going to be fun to go through some of these. And then, as you mentioned, we're going to, for the first time, look at ARM really in depth during our FOMO segment. I'm looking forward to that as a stock now optionable. You see those listed, so that'll be fun as well. But let's do upvote, downvote. As promised, tons and tons of apparel makers and retailers here. Jenny, first one on the list is RL, Ralph Lauren, catching an upgrade.
Catching an upgrade, so Guggenheim did upgrade shares to buy from neutral with a $166 price target, which does represent around 45% upside from where we closed on Friday. Now, the firm is also increasing their fiscal 2024 and 2025 earnings estimates above consensus, citing the belief that there are opportunities to deliver better than previously expected gross margins, aided by some clean inventories, lower freight expenses, and lower cotton prices. Management has stated on earnings calls they expect cotton to remain a headwind on their profit and losses through the majority of fiscal 2024 and to turn a tailwind into the last few months of their fiscal year, which this analyst cited they actually see as an overall tailwind, with things improving quicker than expected. This name, though, skews relatively bullish among those covering it. 17 analysts, 8 buys, 7 holds. There are 2 underperforms, but the average price target of around $136 does imply about 20% upside. Not quite, though, as optimistic as this $166 price target out of Guggenheim today.
I like the logic of the Guggenheim analyst here and more of the actionable stance taken by them. I'm not going to say whether or not this cotton price dynamic they're talking about is going to be ultimately what happens or doesn't. But they talk about, I think, a critical piece here, Jenny, which is if you believe something's going to happen, you believe that's going to influence the stock price one way or another, you want to be in it potentially before that happens. And so they're saying in critical words here, I think, they want to be ahead of this tailwind. They want to be in the stock before this happens. And so even if it's going to happen in the future, it would mean buy now.
Right, and I do like the timing of this because a lot of times we see analysts that are a little bit late to the cycle. This name, though, has not caught the love of some of its other apparel retailers, only up about 9% this year, which is a great transition into our best performing retailer of the group today, and that is Lululemon, which is up over 21% here on the year. Not necessarily seeing the huge outperformance from other names like Abercrombie & Fitch or Urban Outfitters, but still a name that has fared what has been a difficult retail environment, no doubt, quite well. Now, HSBC did start coverage on Lululemon with a buy rating and a $500 price target. The analyst is convinced the brand can continue to grow and dominate its niche, while the company remains in its early innings of growth, given it's predominantly North American, as well as still sees some female exposure in other markets overseas, combined with a very low awareness outside of these North American markets. The firm does see an exceptional story with a unique business model only in, again, that early innings of growth, which was a statement I really liked. Shares are lower today, but this name actually surprised me to see 1 underperform, 2 sells. There are still 23 buys, though, and 4 holds, so still skews optimistically here despite some lone sells in Lululemon.
No, you don't have it.
One could be forgiven today if they just were looking at these apparel retailers and not realizing the market was actually higher today.
No one believes them.
The only name that is actually higher today of all the names at the moment that we're going to talk about the show
nailed the river.
But
I don't
Lulu,
think he has
as
the
you
queen.
said, had a really nice recovery element to it so far in 2023, Jenny. Not today, though. A little bit of weakness, so we'll see how the rest of the day shapes up. Even though it got a little bit of an early pop in reaction to this analyst note,
I don't
it
believe
has
it.
not been able to hold on to it. And so I always think that's interesting. When it's like the news is good, the reaction is good,
That
and then
other
it
queen.
fades. Does that start to mean that the
Hold
stock
on.
is getting a little bit ahead of itself in terms
They
of
both
its
had
price?
queens?
One of those
What
ones
the
where maybe
heck?
the chart will provide more clarity.
All four of the
I
queens are
completely
there?
agree. And now our next name today is Skechers, and I have had to
Dang,
do
enjoy my
some
chips,
digging
guys.
on Skechers because a few
Yeah,
quarters
arms
ago,
back
I was
down to
like, no one is
VWAP,
wearing
or back down to
Skechers, but
open.
This name has been able to fare quite well. It's up 12.5% this year. It has fallen about 16.5% off its
Guess I
highs.
didn't have to call
but
that. I
no
don't
doubt,
know.
this name has actually proven with its earnings history, it's resilient here. Piper Sandler
pretty
upgrading shares
unusual,
to
I feel
overweight
like.
from neutral with a price target hike to $59 a share, up from $54, saying that given the uncertainty of the consumer and U.S. wholesale channel, they're swapping into less speculative, more quality earnings growth names with clean balance sheet, which they actually see now being Skechers. This name does have 10 buys, 3 holds, no bears that I could find this morning, and the average price target of $62 implies over 30% upside from where we closed on Friday. So again, another name that is seeing weakness today by about 1%, but analysts feel optimistically about this name, at least as of right now.
This is an example of sometimes, especially amongst this next generation of investors, that we can be kind of prisoners of our reality. I'm not encountering Skechers on a daily basis. I got to be honest, but that doesn't mean that the company's not doing well and it's not meeting its end consumer, which just might not be me. And I think that what we've seen in Skechers is that they do have a pretty core demographic that they're actually bringing their products to market for. It just doesn't happen to be a younger demographic per se. So one of those names that maybe isn't the traditional definition of cool at the moment, but that doesn't mean that they're not selling products and not a quality company. And so interesting note from Piper Sandler, not enough to keep the stock above that unchanged line here today, down about 1.25%.
Oh my God.
Last one on the list, though,
Hurt.
is the name that, you know, one also could be forgiven for not realizing this stock has struggled mightily over the last few years, because Nike is like the definition of cool, at least when it comes to sporting apparel.
It is, and so it's shocking to see shares down 18% on the year, the laggard of these four by a sizable margin here. Only down about 0.75% today, but seeing analysts that are less favorable on Nike. HSBC actually lowering their price target on Nike to 112 from 120 with a hold rating, saying that although Nike does remain the undisputed leader, but its particularly large exposure to the U.S. market continues to make it more vulnerable here in the short term. As a result, they trimmed their estimates and their price target. Wells Fargo today also lowering their price target on Nike to 120 from 130 with an overweight rating, noting that sentiment continues to drift lower into Nike's first quarter print, where they do expect to hear more bad than good news. Following, they said, some lateral reads in industry checks, the firm does believe street numbers could again move lower to where we
apparently everybody has hearts.
Expecting. This name of the 36 analysts, there are 23 buys, 8
It's not that
holds,
aggressive.
4 underperforms, and 1 lone sell. The average price target of 125 does imply some upside around 30%, but I mean, just not seeing the Nike that it has been for several years here. We do still have their first quarter earnings, like this Wells analyst did point out, on September 28th. So I was reading that as, maybe perhaps we could see this being a catalyst to the upside, but Wells feels this could actually
had one heart and they were calling
provide
that.
some further downside to a name that's now off its highs by 27%.
And where it gets very interesting is if that starts to be the prevailing sentiment that this is actually going to be a downside pressure on the stock, you might actually see the stock weak into earnings. And then one of those kind of sell the rumor, buy the news scenarios take out. So you always got to be thinking one step ahead. There'll be a little bit of a leveling war going on in the market. But I think the two names that pair the best together for the next segment, and definitely the ones that have the most attention from next generation of investors, Nike and Lulu.
Absolutely. And so Lulu, we've already gotten those earnings catalysts. Shares are hanging on to a 20% gain. Nike, of course, the weaker player with still earnings ahead. We'll be diving more into those two upvotes, looking at some example trades as well as key technical levels. Stick around. Next Gen Investing. We'll be right back.
Next Gen I. Yeah, AMC could be consolidating. It's not totally flipped around yet.
present and build up and make up a longer term time frame. So in this chart, high conviction to the upside and a little bit more sideways consolidation as of recent. You can see the move off of 406, that 407 level, and how after that big move, the high conviction to the upside, we've been a little bit more well downward dog, right? Possibly luring in a less experienced or new trader into the potential to try and short this, right? Based on that most recent price activity. But if you take a look at the longer term time frame, I think a more experienced trader and one that's looking at, in this instance, we have daily candles is sitting here, Jenny, thinking, nah, I'm going to stay long on this one because of the high conviction to the upside. You can see from 128 up to 45, and really the fact that we've just been balancing around 365. Now, I mentioned a minute ago the significance in terms of 365, the breakout above. And if you remember, I mentioned the fractal aspect of price activity. This is what we just looked at, the move again, the high conviction move up that we looked at and a little bit of a downward turn. Here you can see on the left side of the screen again, similar pattern, high conviction, sideways consolidation, again, 365 being the key area. Let's take one more step back. I want to show you what's going on with this longer term chart, because again, similar pattern, right? In this instance, 3 examples of that high conviction, sideways consolidation, 130, 190. I mentioned 365, but a minute ago we were just talking about that 15-minute candle chart. This is that pattern, right? Just a blip on the small radar. That last chart we were looking at, the daily candle chart, really incorporated this move to the upside and then the sideways consolidation. And here you can see it just plays out over and over and over again. I did want to take a look at a longer term time frame, but just really wanted to speak to, again, that recent weakness we've seen off that area around 406. Maybe not as big of a deal as it may seem. The real key for the bulls was to get above 365 in this instance, and right now just really looking as that major hurdle right now, 365, opening up a door for a retest of that upper extreme up around 480.
Yeah, so 365, I mean, we are at least hanging out above there.
Yeah,
but
straight out there. I got to be careful. Probably has it.
This is the importance of time frames, really, because I was looking over the last 52 weeks. We are still only down about 4.5% off 52-week highs. But when you look and zoom out, you can still see a clear uptrend, but it has not been the clear path to the upside as perhaps investors would have hoped. So in terms of bigger picture, what are you watching here?
Well, taking a look here again, just sort of giving the benefit of the doubt to the
Birds
bulls
flush,
in terms of longer term. I'm looking at the fact that we're holding above the 50-day moving average. I think
got
that's
lucky on that river.
We've been above the 200. The broader market, a perfect example of that. But as I take a look here, Jenny, you're also going to notice that, well, RSI is kind of limited in terms of participation. And that's why I think what we're seeing here right now is a little bit more consolidation. But again, not necessarily getting sucked into the recent weakness off that high up around 407, more just kind of focusing on this longer term trend to the upside and the bull pattern that's been playing out. Be interesting to see if we can hold above the 50-day moving average here right now. Ultimately, hold above that 365 level. That's going to be key.
Attempting to hold above that 50-day moving average with the shares up over 2.5% month to date, but giving
my
back
bet was a
some
little
of that
aggressive.
Steam today. So Alex,
tested the water to this more bet, I guess.
No,
the other time.
This name has not been
a big bet. Thinking it's too big. They all called, and I still ended up winning.
Example trade.
Yeah, and I think that's important to kind of highlight. You got Nike earnings next Thursday, I believe it is. That could be a downwards pressure on the name if what Wells Fargo talked about
comes down a little more, didn't double bottom.
But also we talked about it with this HSBC analyst, this upgrade in the stock, this price target raise. Yet the stock couldn't even hold on to the gains intraday. Are we watching a stock that's fighting it here a little bit and maybe going to work down towards that key level that Ben had talked about around 365? Now, I targeted 362.5. I think it just comes down to what areas you're going to focus on. But this is just one way to look at it. Buying a put calendar, a volatility play in something that looks for an expansion of implied volatility as well as a downwards trajectory. What we did is we went out to September 29th. We're selling
one person
has a 10. Expiration, so this is going to be
four ways.
Very sensitive.
There's a 10.
To those Nike earnings potentially.
Dude, what are you doing?
We bought the October 20th expiration 362.5 put calendar for a $2 bet. That means $200
Probably
in
hearts.
risk. As we zoom out here, you'll see that shape of the risk profile, one that we're used to seeing with these time spreads. That's a little bit more mountaintop like peak. You see over my shoulder, $200 in risk. Jenny, this is a strategy that would benefit from a move towards 362.5, but also a little bit of fear to come back into Lulu. Are we going to hold that level? juice up those option prices, that would benefit this as well.
All right.
And I think it's important that you mentioned that we could see a catalyst in Nike earnings. Of course, they tend to trade in tandem, although that has not been the case as of late, favoring Lululemon. But to shift gears here, Ben, walk us through what you're seeing for Nike, which this name is down almost 1% today, but also is down, I mean, over 20% year on year.
Yeah, basically a mirror image, Jenny, of what we were just talking about in terms of some of the strength in Lulu. We're seeing weakness in Nike. We're actually breaking out of the balance here right now as a high conviction move in line with the trend that we've been seeing. But let's begin with the top left corner of this chart and how we started out. If you remember, just a couple weeks ago up around 103, you can see where the high conviction trade came in play to the downside as we traded into this $97 range, and then basically since we've been more sideways than not, right? I mentioned here in terms of the breakout to the downside right now, this is a new vertical phase out of balance to the downside, and we'll take a look at that in a second in terms of the significance, but just want to again speak to the high conviction to the downside, sideways consolidation that's ensued since, and the efforts here to break out of a range here. Let me just show you what's going on in terms of areas of consolidation that I identified on the way down. You can see 102, 101, 99, and again currently breaking out of this $97 range. Let's take a look, because much like Lulu, right, as you step back, that intraday pattern here is playing out on the longer term here. You can see it in some of the weakness here. 111, 110, I'm sorry, 111, 197 are the current areas of consolidation that we're watching. And again, going all the way back to the beginning of May, you can see the weakness here coming into play. The stock was up around 126, 128, and as we are currently trading 95.40. So nothing to really indicate a rejection of this lower level as of yet, still exhibiting some weakness. Taking a look here at Nike, you can see again, longer term here, we're going all the way back to the summer, fall of 2021 when we were up around 180 into the beginning of 2022. The breakdown that we saw, sideways consolidation again around the 1.5 level in this instance, a longer term chart looking at the balance we've been in basically since we broke down below 130 in the beginning of this year.
Yeah, this is actually almost a perfect inverse of what we're talking in Lulu, because we've fallen and we've sort of been stuck at this new range. So bigger picture here for Nike with that earnings catalyst still ahead next Thursday. What are you seeing?
Well, again, as I look at the 50-day, the 200-day moving average here, another, again, mirror image of what we were just talking about in terms of Lulu holding above the 50. Look at Nike below the 200. I mean, this is a stock that's come under pressure. This is definitely weak relative to the broader market. And when you take a look at it year to date, we're talking down 18%. So coming under pressure. Lastly, I did want to point to RSI, which is also very supportive of this move to the downside. Not necessarily the same enthusiasm we're seeing in terms of price activity, but that could expand at a rapid rate here. One to keep an eye on in terms of some of the weakness. And this is a stock basically that's just coming under pressure. Again, a mirror image of Lulu.
Yeah, that 6%
right. You know, we couldn't have
this month, adding to its near 20% move lower this year. I mean, I can't wait to see what their earnings are, because I think there's so much negativity priced in. We could see maybe a favorable event or continue downside like we saw in, say, a name like Foot Locker. But we'll leave it there.
He's going to take it down.
Break down both the charts. Ben Lichtenstein, our chart master. So now trading this name out, it's a completely different story here in Nike, although they both do operate in the athleisure world. Walk us through what you're seeing, perhaps leaning into the fact that although analysts we had two analysts lowering their price
there is a full house.
That average price does still lie about 30% inside.
Yeah, we got this event next week. That's where you got to begin and end this conversation as far as I see it from a trade illustration standpoint. What we're looking at here is actually selling a iron condor, more of a neutral strategy, particularly because the analyst noted that this might be a negative catalyst for the stock. Well, the stock's been pretty beaten down, and as Ben had highlighted, it's been a little bit more of a sideways stock. So we're looking for more of that into the future, just going out to the end of next week. Selling an iron condor around the current share price. So this stock's right now trading that 95, 96 level. What we're looking at is selling the 101 and 90 strangle, and then buying $30 wide wings to create a risk-defined trade. All of this expires next week, so it's as short of a term iron condors we could do that will capture that earnings event next Thursday on the 28th. And so what we see here is the risk profile. It's one that
Full House beats it, doesn't
if
it?
It stays between our short strikes, so that's 90 and 101. That's max profit. Done for $1, that means $100 in max profit potential. You see that here. $200 in risk is $3 wide spread.
That's not tournament.
Net of the $1
limbs.
leaves $2 in risk, which we know really means 200. Break even, simply subtract from the put side, get to 89, add to the call side, get 102, and of course risk outside those long options. So to the downside below 87, to the upside above 104. Jenny, this is looking for a boring earnings. You know, I'm not a fan of boring, but if you think boring's in the cards, this is a strategy that capitalizes on boring.
And I think with the pullback we've seen in Nike shares this year, that investors would be hoping for boring, hoping for somewhat of a non-event. But of course, with this strategy, with an iron condor, we are risk defined, at least if we see
pretty big
some
bounce around
degree of
SPY.
outsized move. But that's obviously a more earnings pure play look at an example trade here in Nike ahead of that event next Thursday. But that does it for this segment. Now coming up next, we will look at our FOMO name today. That is ARM. After its IPO last week, we saw shares surge, giving back some of that strength today, though now down 9% on the session. We'll discuss that more coming up next.
Then the king got there. You might have a straight though. Or a 10? Pretty big bounce on that level for SPY. See if it's building up a right shoulder over here. 130. In that midday chop. Consolidating. More or less. What? There are 6's one there. Fold, didn't even check. Nice. He's a 6.
To be interested in this investment longer term.
I believed
However,
him.
what does this name have that many names are hoping to have, particularly in the semiconductor space? It has exposure to AI. Look, I don't know that it's going to be as robust as NVIDIA in terms of growth and that exposure, or if this is something that can last for a long time. But right now, it's the prevailing wind in this space. Are you tied to AI or are you not? Are you tied to things like electric vehicles and self-driving cars? Those are the parts of the market that investors are interested in, and that's where ARM kind of lives. And so, a couple things that work in its advantage. Well, it was initially looking for $60 to $70 billion in its IPO, end up going to the lower end of its range, and getting to the higher end of that lower price target or that lower target, which allowed for some growth post this debut. But it's already started to spill over. It's down almost 10% here today. Not a great start to the week, but expect volatility in a name that is sort of being felt out by investors right now.
Right, and of course, only 10% of their shares were made public in this IPO. SoftBank holds the rest of the 90% of those shares. And I think it's a good point you made, and that's the fact that we'd already seen revised downward lower range ahead of that IPO between $48 and $51 a share. Then they debuted at around $56 was their first trade, which implied about 10% upside, but that was revised down. Now, their first day of trading, we saw a 20% plus move to the upside, a lot of enthusiasm, a lot of talk all across social channels on this name. But now, like you said, much of that pretty lofty valuation is tied to their potential in AI, which we're seeing analysts, I'd say, a little bit mixed on. Bernstein today saying they worry about some open source competition as well as the royalty expectations in this name. They said that with expectations that ARM will be a beneficiary from AI growth, maybe adding to this premium to their share price, they believe it's too soon to declare them an AI winner, which I completely agree. This is like their third day as a publicly traded company after being taken private nearly 7 years ago. So in addition, they said they remain more conservative on their ability to deliver this increased royalty rates at the pace that management is guiding forward right now. The analyst does see some room for the downside on shares, initiating coverage with an underperform rating and a $46 price target, providing even more pessimism to their downward move today. She said she's also concerned about the RISC-V, which is an open source rival to ARM's technology, saying actually much like Red Hat, who was able to develop a very successful commercial operation, enabling enterprises to take full advantage of the benefits of this open source in a scalable way. They believe that the plethora of these specialists are likely to breed a number of Red Hats that are able to make commercial success, meaning that competition is going to continue to flood this market in which ARM operates. Now, they did say that while ARM's architecture is the foundation of smartphones, they believe the world is entering a post-smartphone era that will see high-performance computing and Internet of Things lead the next phase of semiconductor growth. We do know that the smartphone market has been one that's been a weak spot for a lot of these semiconductors. I mean, it's still, to me, like a massive revenue earner. It's still one to obviously consider when considering a lot of these companies with smartphone exposure in the semiconductor world. But the semiconductor space saw a lot of weakness last week. We saw stocks down pretty significantly on Friday. We saw a lot of these big semiconductor players down pretty substantially that have given back a lot of their strength this year. Still an outperforming space, no doubt, but I think that when you look at NVIDIA, you sort of hope that every story will be the NVIDIA narrative, a name that's up over 200% this year. That is not going to be the case, I think, though, for so many of these companies, and now it's sort of reassessing ARM now that it is a traded company. Like you said, now we have options available. So seeing some weakness, although this name still trades with some high conviction, still seeing outsized volume on the session.
Yeah, just to put perspective, though, the size differences that we're talking about, not even market cap, just revenue generation. NVIDIA is guiding for $16 billion or something like that in quarter. You're looking at like 710 million right now in expectations for ARM. So, I mean, we're talking about a much smaller player, but one with tremendous growth rates and certainly a lot of optimism right now. You look at the analysts, still early days in terms of coverages being issued, but I do see 3 analysts, and they're split. 1 hold, 1 sell, 1 buy. See a high price target of 59 and a low of 46. The middle point of that would be 52.5. So sort of your 12-month consensus price target if you kind of went down the middle there. But I'd expect more and more analysts to weigh in as the weeks roll on. But it goes to show you that this is one that has garnered attention when it's almost immediately optionable. Normally, you got to wait a month or so. So a lot of, I don't want to say exceptions are being made, but this is moving the envelope in terms of activity, and things are sped up. This became optional very, very quickly. It's getting tons and tons of attention on a daily basis from a stock trading standpoint. 25 million shares today traded. Options markets, 53,000. This is comfortable. It's not NVIDIA, but it's a lot more active than some names that have been around for a long, long time. Even a name like Micron, which we associate with the semiconductors, I know it's different. About 50,000 options and only 8 million shares traded. So in some ways more active than even a name like Micron.
Yeah, and that's a good point. And I think it's also important because we were discussing this name with such enthusiasm last week. This name has even said their R&D expenses are starting to weigh into some of their growth. Their revenue has already shrank on a quarter-over-quarter basis. So it's not necessarily like the fundamental picture has been outstanding. We have seen some of these costs naturally affiliated with its growth start to weigh on its revenue and its profits really for several straight quarters. And they do have a pretty sizable exposure to China with 24% of their revenue, which could threaten obviously its long-term growth rate as well when you consider the tensions that have been ongoing between Washington and Beijing, as well as the fact that they have a lack of control over ARM China, which is, I'd say that's another thing that is sort of buried within the lead. ARM has no direct stake in their ARM China. Back in 2022, they actually transferred around 48% ownership to the SoftBank subsidiary and now doesn't have any management rights. So ARM China operates completely independently from that company, although ARM itself does still have its own exposure to China, which I think is an important differentiation. But trading this name here, I mean, I think it's difficult. Like you said, it's been sped up in the process. So I also think it's unusual to see so many analysts covering this name so soon to its IPO. But this whole process just feels like it's been under such a spotlight, under so much scrutiny, and maybe even praise as well. So when trading this name, considering the fact that it is still new to public markets, we were comparing it to Uber, which was the largest. This was the largest IPO since Uber in 2019. And I can recall when Uber and Lyft went public, it was volatile for quite some time before we started to see things sort of normalize.
So first thing, I think that it is a luxury that options are available for investors, because before options are available, you have one choice. Do you want to buy this stock? Do you want to wait? And when you have options, you can structure trades that have different risk profiles. You don't just have to be invested in the stock or not invested at all. You can do things that can benefit from a wide variety of outcomes. And I think that's the luxury of there being options now available in a name like ARM. And so I looked at a strategy. It's a little bit more in the complex realm, but it's a skewed put butterfly. It's neutral to bullish, but ironically, the best case scenario is actually a lower price. And it just happens to be the price that we talked about being that consensus analyst price target around 52.5. And again, it's still early days in that analyst coverage, but as it stands right now, that is sort of the midpoint between those two, differing views on this stock. Went out to October.
ETO still up above
only
VWAP.
Monthly cycles are available. We went to that
Nickel up
first available
33%.
cycle, buying one of the 55, which is basically just out of the money, selling two of the 52.5,
bounce up
and then
11.
defining the risk by buying then the 45 strike to the downside. This creates a $2.50 wide debit spread and a $7.50 wide credit spread. It allows for this whole package, this butterfly, to be done for a credit. That means no upside risk theoretically, because if these options are all out of the money, they all expire worthless, you simply keep that credit and you move on. So 50 cents is that credit, which means if it stays above 55 where it is now, you just keep that $50, you move on. Where things get quite interesting is, of course, a slight sell-off to 52.5, where this thing could expand to as much as a $300 profit. But we say this every time with this strategy, Jenny. Most importantly, it doesn't just boost that little kicker there, it lowers the break even. It increases the probability of success. Break even at 49.5 is a good 10% and some change below the current share price, allowing for some cushion here in a name that is quite volatile. Total risk on the trade, $450, takes place below 45. So in the event that this stock does crater and falls below that 45 mark, which is a good $11 below the current share price, 20%, another way to think about it, you're limited in your risk, only $450. If you were a shareholder in this name, those losses could be a lot greater.
Yeah, and I think that's a very good point right now, because we're seeing some of these price targets, like you said, the average doesn't imply significant weakness, but with a name that's sort of in uncharted territory as far as its trading goes, just given its lack of historical data here, I do think it's important to be risk-defined to either direction when looking at a name like ARM. But one that, like you said, for the very reason that we are seeing options available, still is seeing some massive volume on the session today, even with the near 8% move to the downside. But that does it for our FOMO segment today. Now, coming up next, we will look at another name that is seeing some weakness today. That is VF Corp after a Piper Sandler downgrade. Renita Young will have more on that story for us coming up next.
Bit of a head and shoulders up here on SPY. Added to my puts. Got some making up to do. If we get a move past VWAP.
Between what was left by the weakness in its core products and then what's happening right now. And the economy also believes that just some congestion happening in the broader U.S. wholesale channel is going to actually limit the brand turnaround in the near term.
And this name has seen, I mean, it's down 37% this year, and obviously today's move 4%, almost 4.3% to the downside. Pretty sizable move lower here in VF Corp. It pains me because I used to run so loyally with Ultra, which is one of their shoes, and Smartwool's one. They're expensive socks, all things considered, but they're so worth it, I'd say, when you're running. They save my feet as much as it could be perhaps saved. But when looking at the macro picture, I mean, what is sort of the expectations now going forward for a name that's down, I mean, it's almost 60% from its highs?
Well, it's no denying that a lot of these retail brands are buckling under the pressure of the macro picture, the expectation of it to be softer. And so the analysts at Piper Sandler, they said that they're now swapping out the highly speculative types of stocks for those that are less speculative, and that they have quality earnings growth with a clean balance sheet.
You know what kind of made me think here is, I like Vans, right?
Yeah.
But I like a certain style, the classic style. And I was just thinking, I ordered them ahead of time, and I think they've been in the actual shipping box for like a year and a half. I just totally forgot that I bought them. I need to bust those out.
See?
But you also mentioned that they're investing in new products at Vans. That also gives me a little bit of nerves here. I mean, this is a product that they got some good things going. Do you know they're still going to be making these core products, right?
Yeah, they are still. And to your point, right, I have some Timberland boots. Like, I had them in like 3 colors back in the day, in the late 90s, early 2000s, that were huge back then. It was huge in a lot of the pop culture, rap culture videos then, and a lot of us kids bought them. But I wonder if they are going to boost any more of the classic brands to go along with that. That might be a good turnaround story for them, huh?
And I also loyally purchase Vans, but I'm thinking about how I purchase them. I purchase them through Amazon. So perhaps losing some of those sales, obviously, with so many of us going actually against the grain of direct-to-consumer, going to good old Amazon, which is where you can buy Vans too readily, I'd say, because I buy a new pair like every 6 months because they get so filthy. But that's the way to do it, I'd say. They're relatively affordable shoes. But hey, at least with VF Corp seeing some weakness today, perhaps based on all of our sentiment that we own all these brands, we could see some upside from here, but we'll leave it there. Appreciate the breakdown, Randy DeYoung, senior markets correspondent here for the network. Now, coming up next, it's time for Under 30. We are looking at another retailer that's been beaten down considerably for quite some time now. That is Stitch Fix ahead of their quarterly update. George Tillis will have the preview for us coming up next.
Tillis. Well. Hey, jack all in. Nice. Oh my gosh. Got it with the flush. Oh, that's so messed up. That guy's probably gonna quit. Yeah, he's out. Pretty aggressive raise. Put me all in. All right, 10 minutes to 2 o'clock. GTO 50% still, but 31, bond 11.5. Flusherinos would be nice. Save me, Tom Cruise.
if the company can denote some, cost reductions, maybe some partnerships with merchandise wholesalers, manufacturing supply chain changes, all that can improve the cost structure of the business, and that can be meaningful for a couple of quarters. So, I'm not saying it's a buy here. I'm not saying it's a sell here. I'm just giving information, and I am still, apprehensive here, because if you just look at the earnings profile, it doesn't look good. But at the same time, shorts have been covering, at least compared to last quarter. So, like I said, seasonally, there may be a lift here for this company as well. I talked about Skechers earlier on Trading 360. That's been down about 6 to 7 weeks out of the last 9. So overall, I think there's some perhaps seasonality push that could move the stock higher, because the market capitalization is quite small, below 400 million.
Yeah, and George, it's amazing to see that their revenue, I know not comparable to where they were several years ago, but it is expected to improve on a year-over-year basis. So that's something. So I guess to my surprise, this company is mitigating some of its costs and finding new customers amazingly enough. But we will leave there. Really great breakdown on Stitch Fix ahead of those quarterly earnings today after the closing bell. George Tillis, Senior Markets Correspondent here for the network. That also does it for Alex and myself for Next Gen Investing for this Monday. Coming up next, we have the Watch List with Nicole Petalides.
If 2 o'clock will give us our move. Ace King, look at this hand. Got lucky on that river. Yeah, TTO going. Yeah, 44 cents on it. That is neat. Got a resistance line there, 45 cents. Gap there too. Oh, just the left shoulder. Jack 9. King 8. What are these guys doing, dude? Bluffing, I guess.
Cover there. Thank you for that. Sure. Let's get the bigger picture. Darius Dale's with us, founder and CEO of 42 Macro. Darius, thanks for being here. It's Fed week. We'll hear a lot on Wednesday. Your thoughts about the week to come here? A busy one, no doubt.
No doubt. Thanks for having me. So clearly the highlight of this week from the market participants' perspective is Wednesday's FOMC meeting. We think they're probably going to get whipped around, chasing some of this inflation data lower and likely revising their 2023 dot plot projection down by one rate hike. But to my perspective, the big event this week, the main event from my perspective, is the BOJ meeting on Friday. We could see another round of bond market volatility if they decide to revise their yield curve control policy. And one final statistic I'll throw at you, Japan is the only major economy in the world that has an above trend reading in its real GDP growth, its composite PMI, and both headline and core CPI. It's very likely that the BOJ continues to tighten policy this fall.
Right, understood. So, you know, as we walk, they've had obviously very loose policy. They've been a little less in that camp of late, as you know. So I'm also waiting on that on Friday as well. Tell me a little bit more about the Fed's game plan, what you think they should do or what they may do, and how markets could react in the scenarios, or a most likely scenario in your mind.
Yeah, great question. So I always say, we should, as market participants, anyone trying to make money in financial markets, we need to separate what we think the Fed should do from what they are likely to do. What they are likely to do is stand pat on interest rates and effectively signal that we're making substantial further progress towards achieving their inflation objectives. Recall that if you look at the last month's labor market report in terms of the jobs report and also the JOLTS data that supplemented that, we are making a lot of significant progress in the direction of immaculate disinflation. We saw the hires rate and the quits rate both slow back to their pre-COVID trends. So that's giving you an indication that turnover in the labor market is back to a normal level, which would ultimately lead wages lower. And we're expecting the wages print, particularly the employment cost index at the end of next month, to actually show some meaningful deceleration to the downside. But we're also getting very late in the, it's very late innings with respect to this immaculate disinflation theme. We suspect by the end of the year, early part of next year, the narrative surrounding inflation and what the Fed may have to do in response to that could be very different than what they're faced with today.
When you talk about our outlook, I know you're also thinking about, in addition to the Fed, you have the UAW strike and a possible shutdown of the government. How do those fit into the economic picture for you?
Well, it's going to make it very difficult to sort of make any sense of the economic statistics that we're going to get here in September. So you're going to have to throw the baby out with the bathwater, unfortunately, and just stick to where the trend in the data has gone. With respect to the UAW strike, these are the kinds of things you see late in the business cycle. And one thing that I think is really supportive of this kinds of activity is this sort of excess demand for labor relative to labor supply that we continue to observe in the U.S. economy. You know, we are still tracking at about 2.4, 2.5 million in demand in terms of worker demand, units of workers demand in terms of total labor, total employment, and total job openings relative to the size of the labor force. So you're going to see more strikes until this economy goes into recession. The workers have the upper hand as it relates to these negotiations, and the only way we're going to get to a different state from the labor market standpoint is actually going through the fire of a recession.
Yeah, at 42 macro, are you? You're not giving market advice or investor advice, but you're looking more at the economics and the trends and maybe the global picture and how that fits in.
I would say that I would take the other side of that. I think we give some of the best investment advice in the world, quite frankly. A lot of our clients would.
Tell me. I didn't want to put you on your heels. Tell me.
No, I'm always on my front
feet. What's your advice? Yeah. No. So tell me, what's your advice for investors?
Yeah, so we're still in a reflation market regime. Reflation is a risk-on regime. You buy the dip in reflation. You lean pro-cyclically from a factor tilt standpoint until further notice. We ultimately understand that, I think we're pretty consensus now. We were not consensus at the beginning of the year when we said, hey, there's not going to be a recession this year. That's very consensus now, but, obviously investors have to learn the hard way to get to that view. We are now consensus in expecting a recession to commence in the first half of 2024. And as a function of that, the market is likely to peak sometime in Q4 or Q1 of next year. And so you do believe there's more right tail risk in the equity market to price in, but there's also more left tail risk to price in the bond market. One, as a function of the change in Bank of Japan monetary policy over the next few months. But again, as I mentioned, we're also going to transition from immaculate disinflation as a market narrative to sticky inflation in the coming months here in the U.S. economy. And that could be very much the death knell for this bull market, but we're not there yet.
Yeah. On Friday, for example, at one point we had all 11 sectors lower. When you see sell-offs like what we saw on Friday, which was the worst day of the year, I mean, we really saw some serious selling. Would you say there's buy the dips, or there's certain opportunities on sell-offs like that?
There is a worst day of the year?
Great question, Nicole. So it's about the quantitative risk management setup. As I mentioned, we're still in a reflation regime, so that's giving you a green light to buy dips and risk assets broadly.
Oh.
The S&P 500 is still neutral from the perspective of our volatile adjusted momentum signal, so that's fine in terms of being able to buy the dip. The NASDAQ and Russell 2000 are actually still bullish. So from a momentum and volatility standpoint, you very much should be buying the dip until further notice. We know all the reasons why the market is going to go down a lot at some point in the next, let's call it 6 to 9 months. But if it goes up for another 5, 6, 7% between now and year end and then starts going down, there's going to be a lot of bears that get squeezed and lose a lot of money as a function of that.
Right. And are there certain sectors that stand out to you? I mean, or do you do a barbell approach and put something more risky with something more defensive, for example?
Yeah, great question. I go tech and energy. I mean, tech and energy are two of the best performing sectors historically in the current Goldilocks regime that we are experiencing from the perspective of the U.S. economy. I don't think Goldilocks is going to be persistent. We're probably going to transition to what we call deflation, which is growth and inflation slowing simultaneously at some point in the next 2 to 3 months. But ultimately, if that's the case, then you're going to be able to get paid on that technology sector. But if we're wrong on that expectation, you have to barbell it with things like energy, basic materials to account for the fact that we are starting to see some thrust in some of these leading indicators of inflation.
All right. Darius, it's great to chat with you. I pitch him, you hit him, right? Darius Dale, thank you so much. Founder and CEO of 42 Macro. I appreciate it. Or, if, I should do a football reference. Wasn't that a football jersey? He caught my pass. All right, we're just getting started here on the watch list. We'll cover the biggest movers here coming up. We're watching Moderna very closely, and we'll tell you why the shares are down nearly 10%. Schwab Network, we'll be right back.
Fresh buy-in. Give me some good fresh cards. Yeah, TTO, 60% there. Right up to our resistance. See what we get. Watch this, good cards coming out. Not yet. 44, 46 on TTO. Got a nice right shoulder. Wants to reject. Don't like all those diamonds. Oh, I do. How do I get more chips in here? Gone higher. Oh yes, someone landed the flush. Well, there's not a straight flush out there. Do like a bluff bet. Diamonds, I hope he raises. Ugh, just a call. Didn't have any. Going with the high card, Jack. Could have gone all in just right away. They would have called probably. My detriment to play it smart. Got a jack. Great bluff get you. $2.15. Spot looks like I might want to keep going. Full flag. Why is this such a big pot already?
Based on installations and revenue after initially announcing the fees just 6 days ago. Now, several video game developers said last week they would boycott Unity until the policies changed. Stock is down more than 10% this month.
Another club would be neat.
That stock is up 2% today after analysts at RBC Capital, UBS, Wedbush all raising their price targets after the company reported its earnings last week. Now, Wedbush's analysts pointed to the company's much more positive fiscal year 2024 outlook in a research note. Lennar did beat earnings estimates on the top and bottom lines last week, and
I still chop around 215.
37% in the third quarter. And here's the latest move on Bitcoin. Right now, 26,875, still higher. Had been up over 27,000, up 1.5% right now. Okay, let's keep the conversation going. Eric Metz is with us, President and Chief Investment Officer at Spider Rock Advisors, joining me right now. Fed Week, what do you would say? I mean, right now, it certainly looks like they're not going to do, people are not anticipating a rate hike, neither in September nor in November, really. I'm just not hearing a lot of, support for that. But our last guest earlier today did say he's in favor of a rate hike. We're very worried about inflation. Your thoughts?
Yeah, appreciate it, Nicole. I think we are definitely in a data-dependent environment. Last week there was some ebb and flow, and the NASDAQ, which I would consider a long-duration asset, completely tied to the sensitivity of rates at this moment in time, albeit a swift rally this year for maybe different reasons, is in scope here. So, I do think there's a tug of war. I think the last guest also said what we think the Fed should do and what the Fed is actually going to do may be different things at this juncture. And so there is a clear lens into both inflation, but also into unemployment and the consumer. And so I think interest rates will have a lead lag effect into the consumer. And I think the Fed is very understanding of this and waiting for that data dependency.
Right, and so that's the whole thing. I mean, and you're hearing that abroad too about data dependency there. And are you concerned that you could actually have a little bit of a trickle effect? I mean, we've had slowing in China. There's been some concern in Europe. Here at home, while things have seemed so fine and dandy, you have gotten some mixed reports, which could show some concerns for weakness.
Yeah, I think the market has had such positive returns year to date, with the S&P, call it 16%, the NASDAQ upwards of almost 40. A lot of people got caught off sides that was not consensus early in the year. And so if there is any hiccup in forecast or any Fed policy that goes without trend or goes without expectations, I do think there's some I'll call it forecasting of a market pullback, right? With year-to-date returns such as these, you're forecasted on an annualized capacity of north of 20 and almost 50% with the NASDAQ specifically. So I'm really curious to see what this fourth quarter holds. Obviously, the Fed has got the markets in its hand with interest rate policy, but time will tell as the data comes through.
Tell me about tech and energy. Our last guest said he liked tech and energy. I think that's something that you also like. I mean, even with the run-up that we've seen and some volatility in the groups, is that where you would put some money to work, and why?
I don't know necessarily about putting money to work there per se, but given the market cap weights of energy almost on the opposite end of the barbell as tech, technology is roughly 20% of the S&P energy is roughly 3 or 4. You could see a fourth quarter rally independent of where energy goes. Crude oil, I think, is embarking up $90 and $100 a barrel, both in Brent and WTI. And so figuring out where that sector has, it's a little bit of a growth versus cyclicality play, or growth versus value in those two sectors specifically. So I think your last guest was talking about that barbell approach. I do think it's hard to see a market sell-off without technology selling off, given its weight. So looking forward into Q4, I think the energy sector can move independently of the broad-based markets, whereas I think technology is completely linked to the broad-based markets.
So these names like Apple and Meta and the Magnificent Seven, and people ask you about them, what do you tell them?
They've had such good fortuitous runs. Meta specifically had one of the largest rallies, absent maybe NVIDIA this year, which really caught some people off guard. But for those that have been in those positions and they're looking to trim, taxes are the real focus. And so thinking about ways to alternatively mitigate risk, our core work is in options and providing after-tax returns with the solutions and the objectives of our clients. But, at the end of the day, the sector in general, that being technology, has had such a windfall this year. More to come, possibly. I think the interest rate environment can dictate that. But I also think, as you think about the names specifically, those returns in the sector are really concentrated into 5 or 7 names, as you mentioned. So really looking at your portfolios and where that outperformance has existed, just understanding the ramifications of holding that risk going forward.
Yeah, and by the way, folks, Apple's up. I, did see some headlines cross as we were talking about Apple. Is higher today. It's up about 2.4%, noting the Apple iPhone demand that they're seeing, and that seemed to be a good thing, and that's why the stock is higher today and a leader in the Dow Jones Industrial Average. That being said, tell me about the VIX. Do you actually trade the VIX, or you just look at the volatility and make some decisions based on that?
All of the above. The VIX is the barometer in the industry, call it the fear index of sorts. There's definitely some complacency at this moment in time. VIX, roughly speaking, is around 14. I think last week it maybe had a 12 handle in its print. But that is the I'll call it recipe for the cost of hedging. It's got some fallacies in that it's only a 30-day option. There are many I'll call it more optimal ways to construct hedges in various market conditions. But no, we perform VIX analysis every day for clients, S&P term structure and the options prices they're in, which obviously are the constituent math that support the VIX. But there's an element of complacency right now. And I think fast forwarding 2, 3, 4 months, there's a chance for for the VIX to rise, especially if the Fed does anything that this juncture is not consensus.
Right. Tell me about the IPO market. When people ask me, people do literally ask me, should I be in ARM? When Instacart comes, should I get in? What do you tell them? Because it's exciting to have IPOs coming to market, tech IPOs. These are unicorns, Instacart, and also Klaviyo, which will be another one. And these are over, obviously have some decent valuation of more than $1 billion. So when you look at that, what do you tell people on IPOs?
Yeah, I mean, we work with a fairly large swath of clients that have been fortuitous in their private market investments, and so as they monetize that private market investment into the exit of an IPO, we're obviously consultative in that. But I think the other thing is the IPO market for the balance of 2022, looking back a year ago, was fairly dried up, and so now that I'll call it the appetite for IPOs and risk in general is more on the forefront. There's a price for everything. Some of these IPOs have been oversubscribed. And so when we think about managing IPO risk for clients, it's in what sector. So you mentioned ARM, it's technology and semis. And it's got a lot of buzz around it. And so whether or not you can hedge that idiosyncratic exposure in the IPO itself,
Got stopped out on the rest of my ACB.
Shift gears into more macro, that being the sector and technology.
That's to be a nice pickup,
we are going to work with clients to figure out and ascertain where their risk reward is. But price and sentiment is the $1 million question for every single security. And so we're not going to be in the business of forecasting where any IPO can trade in the next 30, 60, or 90 days. It's really about being a sounding board to risk management in its whole.
It's backing down a little bit here.
Through time in a tax-efficient manner.
Yeah, and
might be breaking out of the range.
Oil's headed. I mean, do you see
Get back to VWAP.
We're getting not that far away.
Eventually.
The momentum, I think we'll probably carry it through there. We try not to prognosticate on price direction too much, more just on the volatility of oil. And then within the equity sectors, the broad-based sector ETFs of XLE, OIH, XOP, there's some of them that are embarking upon, their 2, 5, 10-year highs, and others that have some room to run. So really understanding where that energy market goes will be dictated by oil for sure. But I do think, per our earlier chat, energy is one of the sectors that I think can move independently of the broad-based markets at this juncture.
Eric Metz, Spider Rock Advisors, thank you so much for being with us today. Coming up, more on the UAW strike on the big three automakers heading day 4, and now talk about Stellantis. We
Start pushing these guys a little bit.
See some more strikes coming in 18 facilities. Coming up.
Hope it doesn't have a straight. Doesn't. Like 7s won't do it. I come down a little more. I think I called it 5-3. I love it. Oh, I missed the clubs. Well done. Got his money back. He was waiting for that with my aggressive play. $66, yeah, TTO. Right above that resistance. If it rejects up here though. Oh, he's muscling. Even. Got scared.
Over at Tesla because they're not unionized. At the same time, you might even see a Tesla plant in Turkey. That was one of the headlines today. But when you think about now versus yesteryear, in the olden days, it was the big three. I mean, they really didn't have a ton of competition here at home. And now there are so many automakers, so many types of automakers. Are these demands, and I'm not asking you to say that they are or aren't, but some of I'm hearing on the one hand, the president says, oh, the companies are doing so great, they're not passing on their winning gains. And at the same time, I'm hearing some of the analysts saying that these companies can't
balancing
afford
right there.
40% raises and pensions and 4-day work weeks.
Yeah, not the way they're structured today, and they're still operating basically under the same models they were operating on a decade ago, even longer. So they have to modernize their plants. They've already promised to go all electric in the next 5 to 15 years, depending on which automaker we're talking about. That's going to cost more. Making electric vehicles is super expensive. In the early days, just ask Elon Musk about that. Took years for that company to turn a profit. Some of that was intentional, but still, this is a massive transformation. It requires probably less workers to make EVs, but it still costs more money at the onset. Yet the UAW is essential to the auto manufacturing, the whole ecosystem. So you need the auto workers on the one hand. At the same time, they have to change their business models because the profitability is just not what it was. And when you look at the share prices over the last few years, I just looked back 10 years, Tesla up almost 2,400%. Now there's some allure of Tesla and a lot of believers in the stock, but GM just up 24% in 10 years, Nicole. Ford 17% in 10 years, Nicole. Who wants to buy those stocks? The growth potential is not there. Auto investors are looking to EVs, they're looking overseas for the better deals, and they're finding them.
Yeah, I was going to ask the question, but that's winner, winner, chicken dinner. When you look at, when you're up 2,400%, it's incredible, basically, when you see a stock doing that in that period of time. The last UAW strike lasted, what, about 40 days, right?
40 odd days. That was
TTO rejected that high.
Okay, so from that event, and it's just a random question, but you think they learned anything from that to now, or is there anything to take away from that to now to help us understand anything better?
Yeah, that was a 40-day strike in 2019, I believe, just against GM, and that cost the company some $2.5 billion. But these strikes also they take out the momentum from these companies. And the way the UAW has structured the stand-up strike, they've targeted these 3 specific plants that make the most profitable vehicles. These are the vans, these are the mid-sized trucks, right? These are the SUVs, and they could roll them out to any other plant at any time, which keeps the automakers back on their heels because they cannot order parts in time. They don't know what's going to happen with their supply chain because they don't know which plant is going to be next. So they're in a very tricky spot right now. And for all 3 to come to the table with a master agreement that the UAW is going to agree to, especially given its demands, that seems like a super tall order. So did they learn anything? They learned that it's getting harder and harder to run massive auto plants with union workers who want a bigger piece of the pie and probably deserve it.
Yeah, it looks like Janet Yellen's trying to quell concerns today. I mean, she did note that oil, which has been climbing, expects soaring oil prices to stabilize. I feel like Janet Yellen came out today and says, I want to try and smooth things. Because this morning when she was asked about the UAW strike and the economic, outlook for this, and she basically said it's too soon to try and speculate. And so I think she's just trying to keep her fingers crossed until this gets settled. Thank you for all of that, Caleb. And to your point, when I mentioned Tesla, I know you had some the non-U.S. automakers, they don't have, will they benefit? Toyota, Nissan, Honda, Volkswagen, Tesla, used car market. You had that list here too, and those are names to watch as well. Caleb Silver, always glad to see you, my friend. Investopedia editor-in-chief. Caleb Silver, thank you. Still ahead, we'll get an update on the markets. Our next guest will explain why he thinks that the Fed has no choice but to hike rates again this week. What? That would really go against the odds of what everybody else is saying. He'll explain.
Wars again? GME slowly climbed up, down 1.9. Oh, it hasn't made it to VWAP yet. Oh, lucky on that. That obvious? Nice. Noise. That obvious. Nicola must have retest the highs again.
That's accepting, focusing, I should say, on the positive, as I've been saying for a while, discounting the negative. Negative being rates at these extremely stubbornly elevated levels, crude oil, the US dollar right now, some of the other uncertainties about the economy and what's going on overseas right now. But the positive being the fact that the Fed's not going to raise rates on Wednesday. I mean, I think it's pretty much, I don't want to say written in stone, but accepted across the financial community that the focus here is going to be a little bit further out into the end of the year, Nicole.
Yeah, and as we see oil prices, the third consecutive session, closing with another fresh high, and talking about this tighter global crude supplies. All that you cover, all the time for us, Ben. Thank you so much. Great to see you. Appreciate it. Let's kick it off here and talk more about the Fed. Tai Young is with us, CEO of Tai J. Young Wealth Management. Look, what are your thoughts here about raising rates?
Hi, Nicole. Great to be with you again. I think the Fed has to raise interest rates, and if not in this meeting, in meetings to come very shortly, because their mandate, and we all know there's a dual mandate to keep inflation under control and to get in full employment. And their mandate is to do that, and inflation is still high. It's not as high as it was, but it's still high. And if we measured inflation like we measured it in the late 70s and in the 80s, it would probably be 8 or 10% because we don't really measure food and fuel to the same degree that we actually use it. GDP is 2.1%, so the inflation rate is far higher than that.
And the Fed's mandate is to get that under control. The only lever they have to pull is to move interest rates up. And I think they do it in this meeting. And again, if they don't, I think they do it in meetings to come because they have to get inflation under control. The government continues to spend money at historic rates, like drunken sailors, really. And that generates inflation, and the Fed has to keep it under control. And so I think they're going to raise interest rates in this meeting. I think they have to.
And, it's interesting because that's not what, Fed funds futures say. But at the same time, you have the UAW situation. I'm using some of the notes that I was talking with Caleb Silver about from Investopedia, and just the costs of autos and people. And that's another inflationary point, right? So if autos are up 25% since 2019, and they actually have a 10% pay increase, that's 4% increase as well on prices, and it's going to be more than that. So we could be facing more and more inflation.
Well, there's no doubt about it. And
oil.
Yeah, and I think that's right. And I think we are already. If you look at consumer debt right now, it is at an all-time high. And we believe it's at an all-time high because people are not able to pay their bills because inflation, because things cost so much more. They're having to go to their credit cards, and they go to their credit cards month after month after month to pay their expenses, and that's where you get the ballooning debt. That's a telltale sign to me of inflation. So yeah, the cars are going to cost more, daily goods cost more, food costs more, fuel costs more. That's inflation, and we've got to get that under control. And that's why, again, I think the Fed has to make a move. And I hope they do it sooner rather than later. It's not what I want, but it's to get inflation under control, we've got to do that if the federal government's not going to stop spending money. I wish they would and pull back their spending, but I don't think that's going to happen, especially not in an election year. So that said, the Fed has one arrow in their quiver. That's raise interest rates.
Yeah, and look, you said the Fed doesn't really have too many deterrents in that the labor market's still really tight. So they can raise rates.
That's right. The labor market is tight. It's effectively full employment. Market is stable. So their only thing they have to focus on is to keep inflation under control. And there's other telltale signs in the economy as well, but that's what they have to do. So for investors in this environment, it makes them edgy. It makes investors, I talk to them every day, it makes them very edgy about what this market will do.
Right, understood. So what are we leaving out here? I mean, we have the U.S. dollar at this 104 level. The VIX has been relatively low. It's still in the 13, even getting closer to 14. Anything else that you're watching? And, because investors need to make some decisions on where to put their money to work. What do you tell them?
That's right. So the people that come to us, they want their money safe and they want it growing. You can buy a CD right now, a one-year CD, 13-month CD, you can get 5%. But people want more rate of return than that if they can get it. And you can only get that rate of return on a CD short term. So longer term, what we're doing for clients that want safety, that remember the crash in 1987 and 2008, they don't want the downside of the market, but they love what the market did in the last 12 months. And if the market continues up, they want that, but they want to be protected. We use a product called a fixed index annuity. We've talked about it on your program before. That product has your money safe. So market goes down, you don't lose anything. Market goes up, in this environment, you can get as much as 10% of the gains of the market. They lock in on an annual basis, but when the market goes down, you don't lose anything. You literally go forward with your money and never backward, up and never down. And we actually put together a video investor's guide for our clients and prospects. And effectively, you can go to our website, tyjyoung.com, and get one at no charge if you're an accredited investor. And it talks about safety and growth and how you get it in this crazy world that we're living in.
Right, and that's the whole thing here. You want to protect your hard-earned money. Thanks, Ty J. Young at Ty J. Young Wealth Management.
Thanks.
Still ahead, our panel is ready to discuss the very latest from China. So we've been looking at the current market weakness. And how about some of the stocks that are related to China? Names like Alibaba and Baidu and Tencent. In the meantime, the government's iPhone ban of Apple. What does that mean? The watch list will be right back.
SPY getting a little closer to VWAP here. Got 10 minutes to power hour. I wanted to bet big, but nothing to bluff on there. Bet on that river. Back to VWAP. My card, nice. Easy read. Below VWAP. Oh snap. Big inverse cup here on the day. Was this enough for a handle? Wasn't one of the puts here. I don't think that was enough for a handle. Please flush the VWAP, please, please. Mister.
Coming up in a month or so, and 8 of the past 10 times they've beaten earnings on their EPS basis. So
do it.
It's a tricky one to trade right now. It's got support around 87, so if you wanted to pick some up, that's exactly where it's sitting right now at 87. Unless it breaks through and goes downward, you're probably okay buying it here, or perhaps selling puts at a lower level at 85 or something like that.
Yeah. Brendan, sometimes I hear folks who say they like some of the Chinese stocks. There are some people who invest abroad ex-China. They just don't want to deal with the politics of what goes on there. Do you like the group? What do you anticipate? What would you tell investors who are interested in some of these names like Baidu, JD, Alibaba, Tencent?
Yeah, I mean, Nicole, certainly I'm highly biased and it's self-serving. KWeb, our
Yes,
China
both
Internet ETF, is our flagship fund, and we're big believers in the space. I do think one thing, Nicole, is if we just step back big picture, investors globally are overweight U.S. equities. Just since the global financial crisis low back in March of 2009, the S&P 500 is up about 800%. And the MSCI All Country World ex-US is up only 250%. So some people say, well, China's out of favor, China's underperformed, but the reality is only U.S. stocks have outperformed over the last 14 years. That's 56 quarterly client calls or meetings. And it's really driven by the growth orientation of the S&P 500, right? Tech is now 27% of the S&P 500. And a lot of these China emerging markets, non-U.S. equity indices have little to no growth stocks, no growth sectors. And that explains the underperformance, in my opinion.
Complicated?
Yeah,
Oh
quickly,
boy.
Brendan, are
Lushy.
you worried about the China Apple?
Yes.
No. I mean, Apple.
Yes.
You know, Apple stock topped out back at
Yes.
the end of July, and there's talk
Look
about
at that
did
candle.
the Chinese government ban
Do it.
iPhones, but I don't think any government official in
Do
China
it.
has been using an iPhone for work in years.
Holy
The
flesh and
reality
moly.
is Huawei just launched the
Do it.
Pro Mate 60 Plus, so
I gotta
this is
sell
a
one
real
here.
competitor to the new iPhone just getting rolled out, and I think this is more of why the stock fell last
Second
week.
time the
More
last
about this
two-
new competitor in China that's
Well,
been well received. At the same
back
time,
even today,
early indications
which is crazy.
this new iPhone 15 has been very well received, as evidenced
That
by
was so far
Apple's
down.
China website crashing.
Yeah, and so, Kevin, when you look at this group, what names or areas, I didn't put in XPeng. You have EVs too. What areas may show some promise?
Yeah, well, I think if you're going to go with anything, you're going to want to go with BABA. Or, you could consider Apple to be a China play too. I mean, the big debate here is who needs each other more? Does Apple need China more or vice versa? Obviously Apple, needs China for the workforce and a fair amount of sales. But on the other hand, China's got an economy
Head and
that's
shoulders
just
played out.
stagnant right now at best. And they really can't afford to have, a whole lot of jobs go away and, outsourcing to other companies like Vietnam or countries like Vietnam and
bounce
India.
big.
Are
Don't do that.
really
Don't
good.
do it.
So I don't think China wants
It's
to
still easy
lose this
consolidation.
bright, shiny capitalist face they have by causing a problem with Apple. So you could look at Apple as a China play too. And that might be a safer bet than any of these, EVs, Chinese EVs or anything like that.
What a weird day, man. Look at this price action. So
All
strange.
right, gentlemen, I have to leave it there. Brendan Ahern of
Crazy
Crane
chop,
Shares
big
and
wick
Kevin
all
Riley,
morning.
Exponential
This
Investment
weird
Partners.
book
Thank
cup
you
and
for
handle
being
with
with
just
us
huge
today.
wicks.
Appreciate it. That's going to do it for
With
us
the
here
big
on the
rip
watch list.
outside.
I'm Nicole
Head
Petalese.
and shoulders.
Every single day here on Schwab Network, 11
And
a.m.
more
to 2
chop.
p.m. Live
Middle of the
from
day,
New
and then
York
just a
Stock
flush from the
Exchange.
power hour.
Keep it right here, though. Oliver Rennick, Market on Close, next.
All that liquidity had built up this morning just big bounce. I don't like that bounce. I gotta hold these now. Yeah. Slow play this a little bit. Nice, no straight. Oh, big bluff. He doesn't have an ace though. Oh, he has an ace. Oh. Ace 10. Called with a 10. Got all in with a 9. What is happening? Right, bail. Go in with cash game. Go in. Mega bonus. Lucky 777. No way to start it. Mm-hmm. Spy. Line this straight, I did. Oh, flush beats a straight though, doesn't it? Dang, dude. Off you. Wait. What? You had the flush. I got it straight with diamonds, I thought. Pocket tens. Ah. hold any more of these. Ah. I just want to fold out of them. Okay, yeah. Pocket 7? Dang it. Oh, what? I had 2s. I should have closed another one maybe. Might not want to fully finish this inverse cup. I climbing back up there. Dang. We have aces. Thanks. Love it. Welcome. Just chop, rip, flush, chop. How much smoothness today? Pretty choppy. I would have had that with the high card. Gotta have a king, right? Or sixes. I think I was slow playing him. I gotta do that one. Have something. Not raise. I just left.
Home builders who do nothing but make money, Oliver. I mean, they are incredibly profitable because when interest rates spike, people don't go away from buying homes. They wait on the sidelines, and then when interest rates back off or settle, they come rushing back in. So I think there's a fundamental shortage of housing supply that has to be caught up. I think these home builders are going to be busy for years to come, Oliver.
The housing market index from this morning showed a little bit of a drop from the previous reading and relative to consensus. It wasn't exactly a terrible report, but it did show a little bit of worsening on the margin. Maybe some of this related to rates, or should Lennar's numbers, Renita, basically take precedence in our analysis of this?
Well, I think that
I would have had the
you'll see
kicker
that some
too.
of Lennar's numbers are actually confirming
No
those
way.
home building sentiment numbers. So
That's
in
crazy.
the report today, analysts or economists, they said that they noticed heightened promotional activity within home builders, and that they're dropping the numbers, the cost of homes. And in Lennar's earnings, I saw that the average cost of a home actually dropped during that time. But for the moment, you know, it doesn't look like rates are scaring people off entirely, because the housing market is tight enough. People want the homes enough for them to actually still want to buy. And this is why the demand is still remaining resilient. So even though we hear some of those things that are happening within the home builder sentiment report, demand is still holding up.
All right. Tomorrow we're going to get housing starts, which have been a little bit reliable, but we'll see how that changes with rates where they are. A good look at that sector. Appreciate it, guys. Renita Young, Kevin Hanks, thanks very much. And not the only housing data we're going to get this week, because we'll get a few other prints too. Let's talk some tech, though, and go to the opposite end of the market's performance, where ARM shares are down 7.5% after last week's IPO. It was well absorbed, and now the market maybe is looking forward to the next one. It's a busy week at the NASDAQ. Let's go right there, where Karen Snow, the global head of listings, is standing by. Karen, thanks for being here on the Schwab Network this afternoon. Tell us about what's the reason behind the timing here for all the IPOs, it seems, that are hitting over the last week and going forward.
Well, thanks for having me. You know, it's been a time when there's been a lot of demand, but not so much supply. And in terms of timing, I think companies are, coming around to the realization that their valuations may not be bouncing back to where they were in 21. And, ARM, some other deals that are coming to market are kind of proving that out. We're seeing that in the private marketplace as well. And public companies are issuing stock at current valuations. And there's been really a floor in the M&A market. So there's a lot of data points now to draw from as it relates to current valuations.
How do you think investors, market participants should gauge the success of these IPOs at, to your point, this kind of interesting time? I mean, the smartest economists in the world can't figure out what's going to happen a couple months from now. Coming into this year, they all thought we were going to go off a cliff into another financial crisis, and instead we're dealing with now possible rejuvenation of the IPO market. So is it just a success alone for these companies to even make it through and get here, or should they be under some scrutiny a couple months as we look back, see what the prices do?
Well, valuation is always a key indicator. And when we look forward, I think there's more clarity as it relates to rates and some other factors that have been more challenging. Wow. Inflation is starting to come down a little bit. There's always a push and pull. You always have bulls and bears, and that's what creates a market, quite frankly.
Indeed. Right now, the bears are trying to push back a little bit against ARM. What do you think these companies have in common? Are they very different in many respects? I mean, the timing seems like they have something in common. Are they growth-oriented? What do you think they share if we look at, say, an ARM and an Instacart? I mean, on the surface, very different businesses, but is there a thread that ties them together?
I can't really comment on Instacart, but what I would say is the market is looking for high-quality companies with brand recognition that have decent growth and profitability, at least on the horizon.
Do you think the market at this point has tolerance for like pure growth trades anymore? Or what kind of characteristics do you think investors will demand for companies that want to go public right now?
I think they want to see strong management teams. They want to see strong business models that have proven themselves over a certain period of time, that have great visibility, the ability to project their numbers, forecast their business in a way that investors feel comfortable and that they're not going to get blown up down the road. And I think some of the impact with the fluctuation in inflation and how that's affected some companies' business models has caused them to pause and wait until they have better visibility.
Do you think we learned some lessons from the COVID IPO SPAC mania to some degree, or how should we kind of grade ourselves as investors based on the performance of some of those companies over the last couple of years?
Well, the markets have changed a lot since then, and it's always good to look back, I would say. It's important to recognize that there are different times for different types of companies, and the economic environment is a setup for that, right? Rising rates is causing a different type of company to come to market. It requires a different, cost of capital, and companies have to assess that in the bigger grand scheme of things.
Yeah, well said. Probably a little bit more of a demanding environment right now. So, Karen, where and how do you gauge what the potential pipeline is like? Can you give us kind of an idea? I mean, do you think these open the door for more, or were these kind of the low-hanging fruit that we pluck and wait to see how they trade?
Well, we have an incredible pipeline, over 157 companies on file, which is up about 40% from this time last year.
Wow.
I would also just highlight that investors have a higher bar. We're going to see very high quality companies come out. I don't think it's going to be a huge influx. And 2024 is set up for success.
Okay, that's quite a big pipeline. Is there any particular sector, any particular theme, that's driving that, and how fast do you think we can move through that pipeline?
I think it's pretty broad-based across all sectors represented, really. I don't think we'll work through 157 of them, quite honestly, but the point really is that companies are looking to come to market. Investors are going to keep a high bar. They're going to look for those companies that have high visibility, strong management teams, have a path to profitability, and not everyone.
I don't know. I don't know if it's going to keep going here.
Just in case, there's any of these companies that are lingering in the private markets watching, how do you guys compete and position yourselves among the options for exchanges? I mean, what is, do you find that you have to kind of go out there and make your case for these companies right now?
Well, we've been very fortunate at NASDAQ. We've got an 88% win rate for the past couple of years, and we feel very good about our positioning,
around there for resistance.
Really around innovation, growth. We're able to attract the most innovative companies in the world, and that's really because we support them throughout their life cycle. It's a key differentiator between NASDAQ and the other exchanges,
pull back to
and we feel very good about our positioning.
Okay. All right. Thanks for being here with us, Karen. Appreciate the thoughts.
Thank you.
Definitely. All right, an exciting time. A pretty big pipeline and big change from a year ago. Reflects some improved sentiment, it seems like, but definitely a tougher market and a demand for maybe some stronger fundamental bottom line properties for companies. Karen Snow, head of listings at the NASDAQ. When we come back, we're going to get into some picks, talk a little Fed, maybe do a little trading as we get ready for our options corner.
All right, let's see low of the day. Or even pre-market low. That'd be neat. AMC's below VWAP. Down 6.5. Pocket queens. Slow player, huh? No, let's do the slow players. Play fast. I'll slow play them. Oh, you have the queen? Well, I hope he's trying to slow play me here. Do you have it in you? Your pair of tens? Oh, Jack 7. He's like going back trying to review how I was playing that. Like, how the heck? You going for the slow play again? Oh, I had the 3. Poor guy. Still on a little pressure. Take his blinds. Back 4, not bad, not bad. Pair. He got, oh, I fired 2 pair on the river. Oh, poor guy. Oh my gosh. I just, oh, that is pitiful. Pitiful win. You don't got FD approval of open media conference yet? When do they get approval though? Black them down more here. That low of the day. Love to have held more contracts, but risky. Okay, I think next target for me to sell 1 and last, or 25% more. I think probably low of the day. 442.5. Yeah. Or right here. This is the thing, we could be double bombing right here, which I don't like, but I keep coming down. a little head and shoulders here that's formed. Pocket kings? Oh, I suck. Oh, and he had the spade. The flush. Oh my gosh. Got what I gave. So happen to have that king of spades. Oh yeah, might be in that double bottom. It's 3:30 already. We missed Fugazi.
Distribution of electricity across the grid. So Sterling Infrastructure is really a civil engineering company that has a specific emphasis on the E-infrastructure. So we build out data centers, and we think about the growth that we're going to need in capacity for things like AI and of course EVs. So I think that's a really interesting name because it's not the kind of run-of-the-mill civil engineering company that you might find in that industry category.
This thing has gone wild just over the last year. I mean, where did the exponential move come from here? I mean, it was a solid stock in the kind of post-COVID early stages, but just took off like a rocket here the last 6 months.
Yeah, as you know, Oliver, some of the smaller cap companies can really move around. We're kind of excited about, frankly, what lays ahead for this company. So when I talked about the expanding margins and the backlog, I think there's a recognition in the capital markets that these areas, these end demand areas around e-infrastructure, even still e-commerce, is a growth area of the U.S. economy. So I think the recognition in the marketplace, look, these are going to be areas that we're going to have to invest in for a very, very long time. Whether we talk about the computing needs around AI or electric vehicles or even just the continued build out of our e-commerce infrastructure, they've been able to benefit.
Wow. So this is longer term, as you said. This is something you're going to be planning to stay in for a while. Any thoughts on kind of like what's a reasonable value for this company? What's a decent price target?
Yeah, I mean, it's a great question, Oliver. Frankly, we're just not there. I mean, they're still operating in a fairly narrow geographic market. So we'll begin to think about the addressable market and the build out of the capabilities here at frankly, I think a much higher revenue, backlog, and market cap position because this management team has done a good job of winning on some of the large manufacturing deals that have been in the industry, and it's demonstrating that they have an ability to move into other adjacent geographies and even other adjacent e-infrastructure type markets. So, one of the fun things about finding small cap stocks where you like the end markets, you see a long-term tailwind such as AI or EVs, and we think that the trend here is going to be higher.
Okay. We got about a minute. Let's go to the short side. Keep ourselves honest here, Vince. The short consumer play you're looking at, Big Five, has already gotten hit pretty hard, down 39% over the past year, while Dick's Sporting Goods is only down 3%. So how much more does this thing have to go?
Well, there might be a question of viability on this company at some point, Oliver. I mean, as I mentioned at the onset, we are a little bit consumer cautious right now. We think that's slowed down in some of the subsidy-type spending as excess savings get worn down, as the consumer grapples with having to repay student loans. I mean, we look at a category like athletic apparel, which did so well during COVID. Of course, it was one of the things that we spent on. But you look at Big Five within that, and they're challenged because their geographic center is around California, which has been showing a little bit more weakness relative to the rest of the country. The competition in that area really is Dick's Sporting Goods, and even Academy Sports has done a really good job. So we think they have a tough competitive dynamic, and they're having a harder time getting, frankly, the types of brands that consumers desire. They're not able to get access to Nike at this point. So, we think about that one is, maybe the optics of that looked relatively cheap on a PE basis, but we're thinking about where that's going to play out in the longer term, and we think they're going to, frankly, have a hard time competing in that category at a time when the consumer's pulling back a little bit.
Well, if Foot Locker is any indication, it's not good when you lose access to any major brand like a Nike. So certainly understood there. Vince, thanks for the update, and we'll certainly be in touch. Appreciate the picks and the details as always. And congrats on the new game.
My pleasure, Oliver. Great seeing you.
Yeah,
thank you.
Likewise. Vince LaRusso joining us from Cloud Capital. All right, coming up, let's trade some options. We've got the ETFs and the stock picks. Now let's go into the options market. Tom's got a little bit of a hesitant, cautious, bullish trade he found in Netflix, and two more outright bullish trades in BP and Unity. We'll be right back.
I remember
SPY's coming down, test the lows again here. Oh yeah, we might test that pre-market low. We break this. King. But the kicker. Can't wait for this river bluff to get all in. Oh, I'm getting great cards.
Okay, down 0.75% right now. Look, not a terrible day, but just straight down. I mean, 1, 2, what are we now? 3, 5 sessions in a row.
Right.
So kind of interesting. And it does look like a few other charts we've been looking at that are on the border of technical reversal from a bullish trend to a bearish one. I mean, you can maybe start to argue it, but maybe not quite. Netflix starts trading below, 380-ish, then you've definitely got a problem here in this chart. You got 2 more bullish trades, though.
Yeah.
BP and Unity. Let's talk BP as if you think the energy stocks are going to follow crude, you could be in the market for some, good exposure here.
Yeah, but if you look at a chart of BP, oil over the last three and a half
small
weeks,
one?
Yeah,
it's up 16%.
It's done a lot better.
Yeah, BP's only up 10% so far
That's
this
what I'm
year.
saying.
Yeah, so
you think there's a catch-up trade if
they have disconnected a little bit. Now, there was news that came out. You and I were sitting together out at our desks, and California is suing 5 of the largest oil and gas companies in the world, saying that they engaged in decades-long campaign of deception, creating statewide climate change-related harms in California. Shocking that it's coming in California.
Right.
But
shocking that energy companies might have downplayed.
Yes.
Nobody's shocked by anything in this space.
Stated that the companies were downplaying their impact to the environment. So it has disconnected from the price of oil. But if we continue to see oil, above $90, $91, $92 a barrel, maybe some of these names play catch up, and I think that's what this trader was looking at because they went out to the December monthly series. So 3 months until expiration on these. They bought the 40 strike calls 10,000 times, paid a debit of $1.10, so that break even 41.10 over the next 88 days. It's only about 7% above the current share price in there with call volume. Double normal daily average volume that we've seen over the last 5 trading sessions. So, yeah, somebody's sticking their neck out. I mean, the high for the last year has been about 41, 41 and a half. So it needs to get above those levels. But I think the key for this trader is went out to December. So if we continue to see crude rally, some of these stocks do well, you're going to capture an earnings event at the end of October also. So that might be a catalyst to the upside. But, yeah, somebody betting that maybe some of these oil names are going to catch up to what the commodity's doing.
All right. Yeah, okay, makes sense. That's kind of what I was going with there. BP down today, even though crude oil's up.
Not sure if SPY's going to get this moved to the downside or not.
Kind of slow. They're taking their time.
Jimmy's back to VWAP.
Unity.
Yeah.
How come the bull trade here? I mean, the stock's getting hit today, down
7.5%.
Been slipping since its earnings.
Can't rely on Fugazi to bring it down.
It was the backlash that was created on the announcement that the company made last week that they're going to charge their customers,
game
developers, a charge for every download that they have of a specific game. They're kind of backtracking on recent aspects of it. Now, that's not completely. That's why the stock hasn't rebounded, because that news came out of Bloomberg earlier this morning after the stock was already down about 8%. They're backtracking a little bit, but some of the analysts out there are saying, hey, by January 1st, they're still going to implement some type of cap. They did say that Unity did say they will restrict fees to 4% of the game's revenue for customers making over $1 million. So that's a key aspect of it. The CEO and a couple of the other insiders have been selling shares since the end of August. That's not a positive sign for the stock either. They've sold, in the last 3 months, they've sold more than 4 times as many shares that they've bought. So insider sales may be coming into play there. Causing some more of this weakness that we've seen. Stock's down 7% today, down about 9% so far this month. So it's been under pressure. But somebody thinking maybe by the end of the week we're going to see a reversal here because we saw a call buyer in the September 22nd weekly out to expire in just 4 days. bought over 4,000 of those, paid an average debit of about 50 cents. So not a lot of option premium because you don't have much time in this one out of money calls. So that break even at 35.50 over the next 4 days. That's about 4.5–5% above the current share price in there, with call volume double what we normally see over the last 5 trading sessions. And we've seen a lot of volumes in there in the option market over the last 5 trading sessions. So they continue to pile in here, trying to create some leverage using the option market. But this person thinks we're going to see a rebound here, and maybe if the company backtracks, maybe some better press, you get a bounce on the stock.
Okay. They
All these to do for Ghazi.
I feel like it's not an unreasonable thing for them to try and shift their revenue this way, but I guess the market's saying that developers are going to go elsewhere if they do this, because you would think something that might improve their margins and make them more money would be bullish, but I guess Street thinks that they're just they're going to lose their customers. A lot of games that are made on here, basically all like your phone games pretty much. Not all of them, but a lot of them.
Over 50%, yeah.
Yeah, a lot of
Unity?
for sure.
But think about this, when they did announce that what they were going to do before the backlash started, stock did move to the upside a little bit before selling off.
We're closing on these puts.
Thanks, Tom. Interesting options trades. Okay, when we come back, let's get an
On the
update
left.
on the hiring season for shopping in the retail world. Jenny Horn will take a look at that for us. We're going to do some trading as well in the commodity space. Stocks, a little changed.
Minutes to close. I'm down to 1 contract to try and make up for the losses. Am I close it? Yeah, I'm out. Alright, well. Thankfully that drop, that helped a lot. Losses today are somewhat within reason now. Okay. Well, tomorrow, home sales, pre-market, S&P Case-Shiller Home Price Index at 9, consumer confidence at 10. Oh wait, no, I'm sorry. Housing starts at 8:30, building permits at 8:30. Wednesday we have FOMC. Okay. 5 minutes to Fugazi time. Roughly.
Schwab.
He's coming down. I could have held it. Oh well. If we might get that flush. few minutes to Fugazi. AMC is down 6 1/4. GME is down 3 1/2. GNS is down 6, broke that $1 level. TO is up 60%. Got stop out of ACB, it's down 13%. Still in BFS, it's down 2. Ready for like a 100% day on BFS. Uno más? Minutes to Fugazi.
On it, but I feel like you could argue it either way. It's like, all right, they're going to spend some for part-time hires, but that also means there's going to be demand they foresee, which is good. So I don't know, but market right now is like anything that Macy's publishes is just going to hit the stock. So it's like a can do no right company at this point, just crashing now since earnings. I mean, pretty miserable stuff. Thanks for the story, though. Appreciate you. Macy's down more than 3% right now. Got around 8 minutes until the bell. Let's bring in our Schwab team and let's talk about the big picture this week, which centers around the Federal Reserve and FOMC. on a Wednesday. Randy Frederick and Kathy Jones join me to kick off the next 5 days of trading. Kathy's a chief fixed income strategist, and Randy's a managing director of trading and derivatives at Charles Schwab. Afternoon, guys. Should this be a volatility-inducing event this week, Randy, or are markets going to sleep right through the Fed?
I can't imagine why it would produce any volatility. I mean, the only thing that might produce a little bit of volatility may be the press conference, but there's a virtually zero chance we're going to get a rate change. Now, if we got one, sure, that would create a lot of volatility, but I think there's no chance that's going to happen. And I think, frankly, and I know Kathy's going to expand on this a whole lot more, I think Powell's going to be pretty much toe the same line that he toed last time, which is that, hey, we might be done, we might not. We're going to let the data dictate what we do, and we know we're not going to get a hike this week, but there's still a chance we'll get one in either November or December because we have 2 more meetings left. And I think the markets have priced in one more. Right now, the probabilities are a little low for that. But the data, there's a lot of data between now and the next couple of meetings.
And Kathy, what is Jerome Powell's range, you think, this week? I'm a card player. I got a range. Sometimes I bet big if I've got it. Sometimes I bet big if I don't got it. Is Powell only betting big if he's got it right now, or might he try and, keep us on the hook for possibilities of action to come?
Well, you're also an options guy, right? So I think that he's going to go for optionality. Yeah. So, what he's going to do is I think they made it pretty clear that, as Randy said, they're not going to hike rates this time. The door is still open. I think he wants to keep that probability somewhere in the 50-50 area so that markets are, not pricing in too much of a move one way or another, too much confidence one way or another. And then they'll wait and see. They keep saying they're data dependent. I may take a little different view on volatility, at least for the bond market, from Randy. That is that depending on what the dot plot tells us and the updated economic projections and what happens in the press conference, we could see some volatility in the bond market. We're priced for peak rates right around this level. If the dots move up, implying that more members of the Fed see more tightening ahead or pushing out those rate cuts that are priced in for 2024, we could see some volatility in the bond market.
To that point, how do those responses differ, pushing out cuts versus maybe putting possibilities of hikes on the table, Kathy? Are those kind of one and the same, two sides of the same coin, or are those, as far as the bond market's concerned, very distinct things?
Well, I think they're very distinct things. So the important thing is that the bond market is now priced based to a large extent on what the Fed has told us for about 100 basis points of cuts next year. If we starting in about the late first quarter or second quarter. So if we push those out into the second half of the year, say, that means that the short end of the curve has to normalize to that level. So we could see certainly some volatility, maybe a sell-off in that 2 to 5 year area as it reprices for what the Fed might do over the next, 1 to 2 years. It's a subtle distinction, but it would be there. And that's why I think we could get some volatility depending on what those dots tell us about where the Fed thinks it's going.
Okay. Randy, as far as stocks go, no cuts versus hikes, are those basically one and the same as far as valuations? It's all a little bit less liquidity coming out of the system?
Yeah, I mean, what we're looking at mostly is at the most, maybe, again, another quarter in hikes at the very most. And again, that's kind of a 50-50 on whether or not that happened, like Kathy said. So I don't, again, I believe even if the futures markets are only showing a 30% probability and we really need to get to probably 65% before we get another hike. I do feel like the markets have sort of been expecting that. I think one more hike isn't going to derail things at all. Now, again, if we see a big uptick in inflation, and that is a concern. I mean, we had 12 consecutive monthly downturns on the CPI and the PPI. We've now had 2 consecutive monthly upticks. We get a PCI at the end of next week. If that one upticks, I mean, there's going to be some concern about inflation re-emerging and coming higher. I think it might take another month or two, which again will get us to just about the year end before we know whether we really have a problem with inflation. And if he has to start hiking rates again, then yeah, I think equities could get derailed. I don't think that's going to happen. But in the very near term, if we don't have a hike now, we've got to basically have another 5 weeks that we don't have to worry about anything as far as the Fed goes. So I don't think equities are going to be bothered by this at all.
Here for a moment, 10s to 2s as the example. We had some kind of surprise widening out of this curve this summer. This economic data continued to stay strong, kind of flatlined a little bit here over the last couple weeks. What's the framework you're using, Kathy, for whether or not that gets crunched or if it can actually expand a little bit more?
Well, it really comes back to what is the Fed signaling for us. So if the Fed comes in on the hawkish side, indicates the strong likelihood of another rate hike before the end of the year, then I think that you get that deepens again. So we get back below 80 or into the 90 area. As the market discounts, okay, tighter policy means slower growth, less inflation down the road. If it's kind of a wishy-washy, subtle, maybe, maybe not, or maybe we're done kind of message, then you probably see a little bit more of that steepening. Eventually, what happens in every cycle when the Fed starts cutting is you get the bull steepening. We've had the bear steepening
All right,
so far.
2 minutes to close. Looks like SPY's trying to climb back up to VWAP.
Be the big move that brings us back
Will we get that
to
inverse cup?
a more normally shaped yield curve. But
And I don't think today's pump was enough for the handle. We'll probably chop around probably right in that range until Wednesday.
According to history. All right, good combo, guys. Thanks a lot. Appreciate it, Randy Frederick and Kathy Jones.
We're gonna
Nice
get our
setup here for
decider
this week. Closing bell coming
Wednesday.
right up. Got it less than 2 minutes away.
You could think getting commission-free trades is as good as it gets, but you know better. At Schwab, free means more. You get commission-free online trades and quality trade executions on our powerful platform. Plus the satisfaction guarantee. Expect more from your firm. Trade up to Schwab.
There it is.
The better place for
VWAP.
traders.
Did it. Well, yeah. Alright, so not a lot to update. AMC maybe consolidating, we'll see. Don't like that it broke that trend, but next level I'd want to hold is like 750 for that neckline on the head and shoulders. 30 seconds to the bell. It's down 6.5. GME down 3.6. Again, it's still looking bearish to me. So yeah, I just expect it to continue to sell off. Could trade sideways a little bit. Starts to pump up above here, then it should look bullish. And this is all lining up, of course, with Wednesday also. So if the market pumps and GME goes with it, then we'll be right in that spot where we'll probably be building this inverse head and shoulders and breaking that resistance. Yeah, we had TTOL up today. It's closed up 65%. ACB down 12. Bit of consolidation, just big range of this bull flag. GNS down 6.5. So that's kind of a breakdown of that $1. I'll see if 82 cents finds support there. VFS still looking fine. Yep, still like VFS. And yeah, thanks so much for your guys' support. Wipe down account 7 times and leak. Lasted 2 days. Bubba. Gotta survive. Surviving the market is winning. Maybe the lottos on every day are not the play. By lottos, I mean the risk management. Thanks guys for your thumbs up, appreciate it. Got 20 today. Thank you Ace for your gifted membership. We'll see you guys on Discord, Twitter. Thank you. Thanks Bubba, thanks Sergeant. Thanks Siemens. Thanks Guts. Thanks Psych You Up. Thanks Dink. Okay. See you guys on Discord. Peace out.